Good morning. You know what the big red breaking headlines mean. It's Jobs Day here, January 6th in New York City. This is Yahoo Finance Live. I'm Julie Hyman with Brad Smith and Brian Sazi. And we are seeing futures not move very much, as they tend not to, ahead of the expectations for the jobs report. And here are the expectations. We're looking at a growth in non-farm payrolls of 202,000. That's what economists on average are expecting. Unemployment rate remaining at 3.7%, which would be no change versus last month. And then looking at a year-over-year average hourly earnings gain of 5%, that would be a 10th percentage point slower. Although month-over-month is really, I think, what I'm watching. That will be 0.4% according to the average economist estimate. So that's the big picture of what we are looking for here. And of course, there's going to be a lot of talk about the read-through for the Fed. If the jobs report, if the jobs market is still too robust, is still growing too quickly, does the Fed need to be more aggressive?
You're right. What people can't see, our studio is actually lit up already here. For one of the first times I've actually seen this. Hope it's not an ominous sign of what could be the market reaction to this report. To that end, let's pull up the chart that I'm watching, and that is average hourly earnings by sector. This chart comes to us compliments of the folks over at Citi. And as you can see in this chart, despite the economy slowing down, wages in this country by sectors, by and large, continue to trend up. And if that is continuing to be if that was the case again in December, maybe it continues again into January, I would argue, Brad, maybe we do get that red day for the markets, because it has not been, the market has not received good news in a good way.
Well, if the ADP private payrolls number is any precursor, then we could need to brace for what this number may actually look like. But then there's also the added factor of the number of layoffs that have started to roll in as well across companies. And when we really think about how that's impacting over the long term and mirroring some of what we've seen in past recessions, one particular chart that I've been keeping a close eye on is this BLS duration of unemployment, to really get a sense of how long people are staying unemployed for, where they're trying to still work or look for work out there. And that's starting to now tick back up again. You saw that continue to move lower, of course, off some of the unprecedented highs that we had seen during the pandemic. But then that continued to move lower all the way until early first quarter 2022. Since then, it started to tick back up, and that's going to be a big figure to keep your eye on going forward, to really get a sense of if people are able to make their way back into the labor force as well.
And then what I'm watching is the divergence in the household survey and the non-farm payrolls number itself. So non-farm payrolls, of course, is where we get the number of jobs added, right? And that comes from companies. The household survey, which is usually what we track for the unemployment rate, is that just that. It's the household survey. They ask households who's employed, who's not. But the household survey also has a job addition number. And as Bloomberg Economics points out, they've been diverging. And that's why the folks over there think that actually the household number is more accurate. We're going to get revisions lower to the payrolls number. So maybe a more negative, somber sign for the jobs market going forward, but something to continue to track here, because we always like to pay attention to unusual divergences.
And a somber note, like you mentioned, Brad, these tech layoffs that have happened this week ahead of this jobs report. Salesforce early in the week laying off 10% of its workforce. You had other companies coming out here also letting Amazon letting workers go 18,000. I got a good viewer question real quick. As they are watching this, are you reporting about the 18,000 people being laid off by Amazon? Well, we have reported all week, but I will say a number like that does not show up overnight and will not show up in this report. And even in the case of Amazon, it's not like all 18,000 cuts happen overnight. And similar to Salesforce, these cuts will come over a series of months, and in some cases, in the case of Salesforce, years. And
it's part of the staggered impact that some businesses are or have already kind of factored in or have already experienced, or are bracing for ahead of time and trying to move costs around, kind of reduce some of their cost structure, and then just reallocate some of the headcount capital that they have internally as well. But at the same time, the people that are out in the labor force now looking for jobs, it's a question of where they will find them, given that there is that belt tightening taking place.
Right, where and if they will find them right now, because there are still firms that, of course, that are hiring. Well, we're just about 30 seconds till the report, so might as well give you the expectations once again as we set up here. 202,000 is the headline number that we're looking for. Payroll additions, 3.7% unemployment, the 5% year-over-year gain in average hourly earnings, 0.4% if you're looking at it on a month-over-month number, which we are, because we are are looking for momentum in inflation. Is the rate of change in inflation slowing down at all as we get these numbers here this morning? And so just waiting for the numbers to drop here as we're looking. 223,000 is the number that we are getting on non-farm payrolls here, above the 202,000 that economists were estimating. The unemployment rate ticking down quite significantly, 3.5%. 3.5% is the unemployment rate that we're looking at versus the 3.7% that we're estimating. And wage growth is slowing, 0.3%, half the month-over-month gain that we saw last month, and 1/10% slower than estimated. That means the year-over-year gain in average hourly earnings, 4.6%. Average hourly earnings, average weekly hours, ticking down to 34.3. Labor force participation ticking up very slightly, 62.3% is where we stand on that figure right now. I'm also seeing some of the revisions populate right now. We are seeing a slight downward revision in payrolls for November to 256,000 from 263,000. And actually, the unemployment rate is getting revised downward to 3.6% for the month of November. That's a little bit unusual. We don't usually get revisions in the unemployment rate. We mostly get them in the actual number of jobs being added, and the average hourly earnings numbers being revised as well to 0.4% for November from 0.6%. So in other words, wage growth is actually slowing, and it already had been slowing more than the initial look, guys.
First take here for me is that I think that's why you saw futures pop. Because of those downward revisions, jobs for October revised down by 21,000, and Julie, as you mentioned, for November, revised down to 7,000. That suggests the economy has started to cool, and that might play into some of the views on the street. Perhaps we get that Fed pivot by the middle of this year. If we didn't get those revisions, I would argue this is a pretty strong report for the economy. Really broad-based gains and much better than expected.
It is a strong report, and some of the strongest areas that were able to add on or at least contribute the most to this most recent month's employment report. It came across leisure and hospitality, healthcare, construction. You also had social assistance, and of course leisure and hospitality really trying to continue its comeback over the course of 2022. There's also a good nugget within this report about leisure and hospitality. It added an average of 79,000 jobs per month during 2022. Now, it is, of course, substantially less than the average gain of 196,000 jobs per month in 2021, but that really tells you about the recovery that's needed to take place within this sector. And so within leisure and hospitality, you really saw the most additions in food services, drinking places, people making their way back out into some of the social constructs. And the services economy is one that's certainly been trying to continue to chart that rebound here. Amusements, gambling, recreation also added about 25,000 jobs.
And just one more quick thing where we're losing jobs is in professional and business services, down 6,000, which might reflect some of the technology losses that we've talked about.
All right, let's get over to Yahoo Finance Inez Ferre over at the Wi-Fi Interactive. Inez, looks to be a somewhat positive reaction here to this jobs report.
Yeah, that's right. And we did see quite a big movement with the Dow futures in right after that jobs report came out. So it was relatively flat earlier, up about 140 points right now. The Nasdaq 100 futures also had been down about 50 points before that jobs report came out, and right now is up 30 points. So quite a big swing that you saw there. And then the S&P 500 futures, those are up 0.3%, again, coming in from negative territory. Also taking a look at the 10-year Treasury futures. Now this moves inversely with yields, so we saw that yields have dipped after that report came out. We're also checking out the gold futures. That's up about 0.1%. WTI and Brent usually doesn't move too much after these jobs report, not seeing quite a bit of movement there. And then also checking out the US dollar index, and that is up about 0.4%. It's at 105.52. It had been at 105.6. So not a big movement when you're looking at the currencies, but certainly the assets, risk assets, Dow futures up 0.3% in pre-market, guys.
All right, Yahoo Finance's own Inez Ferre tracking some of the immediate reaction here in the futures. Of course, we are still just inside of an hour out from the start of trade here on the day. Just to recap some of the numbers for you very briefly. In the labor force, or the Bureau of Labor Statistics jobs report that came out this morning, the jobs that were added during the month of December 2022 were 223,000. Unemployment rate that ticked down to about 3.5%. And then additionally, notable job gains we saw across leisure and hospitality, healthcare, construction, social assistance. But it was really the revisions that the market seems to be latching onto, as you mentioned a moment ago, Julie. And so we'll continue to see how the futures really start to price that in too here. Also, everyone, for more on the jobs report, let's bring in JP Morgan Asset Management Global Market Strategist Mira Pandit and S&P Global Ratings Chief U.S. Economist Beth Ann Bovino. Great to have you both here live in living color on set with us for some reactions to today's jobs report. Mira, I want to begin with you. You see a reading like this and the markets are going to react the way that they do, but it really seems like some of those revisions kind of caught us off guard just a little bit here this morning.
I think the most important takeaway from this is the downward revisions to wages and the fact that wages are starting to slow. That is the most important thing for the Federal Reserve when we think about how they're looking at inflation. They're looking at goods, which have actually started to decline. They're looking at shelter, which we know is going to be hot for a little bit longer and we have to be patient with. But the big question mark is that services X shelter. And in trying to interpret that data, they are very much closely paying attention to wages. So on the one hand, seeing wages start to slow a little bit more is good news for the Fed. On the other hand, you mentioned some notable gains in the usual suspects, leisure and hospitality, other areas of the service industry that paints a little bit of a conflicting picture there that the Fed is going to want to continue to monitor.
Of course, Beth Ann, at the same time, we get the wages that are slower growth, which is good news from a Fed perspective, bad news maybe for individuals who are not making as much money or not seeing their wages rise to pace with inflation. What is all of this? I mean, is it too early to sort of extrapolate what this means for consumer spending?
Yeah, I mean, my takeaway is, look, it is positive to see, particularly for people who are waiting for the Fed to slow down on rate hikes, for wage gains to start to moderate. But as you pointed out, two things I want to take away, I would want to point out. First of all, the BLS numbers, it is an aggregate number. It depends on what industries are impacted in there. So if you're imagining that a lot are going to be leisure and hospitality, which are largely more low-paying jobs, that could bring it down. That's one thing to take into account. But to your point, we have seen that inflation has outpaced wage gains for now. I think this is probably the 21st month. So those people are feeling the pain. Purchasing power has been squeezed. What does this mean for those people when they go to the shopping center and want to pay? We're starting to see people trade down in terms of spending or search for value. That's a squeeze on businesses who are trying to keep their revenues to outpace costs. So that could be a squeeze for not just households, for businesses as well.
Mira, a report like this, maybe downward revisions to wages and the prior month jobs, good thing. Does that make you more optimistic on stocks, on the notion that maybe we get that Fed pivot earlier and we're not talking about the Fed raising rates in the back half of the year?
Not so fast. It's just one report. I'd say overall, there is a lot in that report that is in line with some of the consensus expectations, and it's still a very hot labor market. If we looked at the JOLTS report earlier this week, we continue to see very high number of openings reflected in this report. Similarly, some of those same industries in terms of service. And if we look at the Challenger survey from earlier this week too, those layoffs continue to be very concentrated in a small number of sectors, primarily technology, finance, fintech, some of the areas where cyclically there might have been a little bit of overhiring last year. And they also continue to be very geographically concentrated as well in areas like New York and California. So I do think that we have to continue to monitor the strength of the labor market because we're seeing that downward progress in different areas of inflation. So I think the Fed's focus has really shifted to the labor market, and I'm not sure that this was a weak enough report. It was actually pretty strong in order to give the Fed that ammo to want to start to ease off of those rate hikes yet.
May I just jump in here? I agree with Mira very, very much. When you look at that jobs opening report that came out, it has moderated, but it's still, 10.5 million, which is incredibly strong. If you take that relative to unemployed workers, that means it's about 1.7 times those people who are unemployed. You'd like to see that closer to 1. The Fed would like to see that closer to 1, so they have a long way to go. You talked about the labor participation rate, which did come up, and that's good news. I think it's probably still very close to a 45-year low, which is, again, a real challenge. We need workers to come back, particularly women, prime age workers. We're not seeing that fast enough.
So what does that tell you about the vigilance of the Fed? I know you had used that word in your notes before. So what does this report then kind of signal about that vigilance of them going forward in this year too?
They're still on watch. I do see with watching the wages start to soften, that is a positive, but I don't think the job's done yet. We're looking at the Fed. We do expect the Fed to continue to raise rates. We're looking at the Fed to get it up by to a little over 5% by, I guess, the end of this year. I'm sorry, by mid this year. We don't think, the question is, could they go much higher than that? I think with numbers like this, particularly with the wage gains coming down, that's a real positive. As I said, let's see what the distribution is, and is it really just driven by low-paying jobs? But if that's not the case, if you see it much more broad-based, that does give the Fed time, a reason to start to slow the pace, and that's a positive. But again, even the Fed said during the minutes that their job is not done.
Mira, I'm looking at futures here, which are up on the back of this. What I'm hearing from you guys doesn't support that necessarily. In other words, this report doesn't seem to meaningfully change the trajectory of interest rates from what I'm hearing you two say. So what do you think is going on here? And do you think that the buying stocks on the back of something like this is a good idea?
I think any little crumbs of weakness in the report will be received in the immediate aftermath positively by the markets. Let's see how the next couple of hours, the next few days play out as we think about the overall strength of this report in the context of a strong labor market. But I also think that maybe one of the themes that we're going to see in terms of stock market performance this year is that everyone's expecting this recession. Everyone's expecting a more protracted downturn. We know that markets tend to bottom before the economy, before the labor market, before earnings. So I actually think, in contrast to last year, dip buying is going to be a lot more popular as an immediate reaction to some of this different data throughout this year, because people will say, well, maybe the bottom was already in October, so I don't want to miss out, whether it's stocks or bonds. So I think that behavioral reaction function might be a little bit different in 2023 than in 2022. I think people are looking for an excuse to buy a little bit.
Beth Ann, bigger question here, or bigger picture question here, is the power back in the employers? I felt like last year we talked a lot about quiet quitting, but this report supports maybe that shift is now, going back the other way.
I don't see that at this point in time. Look at the numbers. I mean, I think eventually you can see that dynamic turn around, but as I mentioned, job openings 10.5 million. That's one thing to say that there's still businesses looking for workers. You're looking at the wage gains, and you have seen it modified, but at, 4.6% or so, that is incredibly high relative to what is the median historical rate. The median rate for wage gains year over year is about 2.5%. So it's almost twice that level. Again, meaning that businesses are still searching for workers. What I see as a positive is that if we see businesses start to say, well, let's just start to freeze hires, get rid of those, close out those job openings, but keep the workers we have, that could be, in a sense, a win-win for both businesses and workers. But again, it still remains to be seen what happens.
I don't know how granular you get in your analysis, but I do wonder, anecdotally, we've been talking about all these tech sector layoffs. Do you think those workers are going to be absorbed elsewhere? Is there enough slack in the labor market that there are other jobs for them?
Well, right now we have, again, I mean, I don't cover industries, and Mira might be able to comment on this. But what we see here is that, with an unemployment rate at what it stated, it went.
Now I'm forgetting something that I saw 2 seconds ago.
3 point something.
3.5%.
It's jobs day.
3.5%.
Yeah, exactly. 3.5%. That's incredibly low. There's so many people who are out of the workforce. There's still demand that it's very tight in terms of job openings, as I said. Still, business demand for workers is still very high. You can see it softening, but so I imagine that those people who have left the workforce, who either were laid off or for whatever reason, will be able to easily find something else.
Mira, you had mentioned this buying on the dip mentality that might reemerge here. And yesterday I was, and I think many of us may have been educated as to what the mullet trade is. That was the first time I'd ever heard of that. And so within this buy on the dip mentality that
I think Brent made that up, to be fair.
Brent made that up, okay.
I think that was his invention.
Well,
I'm not sure.
Brent Thill over at Jefferies invented the mullet trade on the spot and gave us some timing and said that we could just be kind of in this obscure and kind of downward declining phase over an extended period into 2024 even, with a back half of 2024 rally. And so especially within tech there, if we did see any buying on the dip activity here, even within this market, off of the volatile reports that could come out as the Fed is looking for a trend, how can somebody kind of position their time horizon over an extended period to really feel comfortable with buying on any dip that they may see over the course of 2023?
Markets do not like uncertainty, and I think that right now, as that soft landing conversation reemerges, sometimes it dies down, it builds back up. We were just talking about that earlier, and that kind of uncertainty of a muddle along type of economy keeps investors a little bit on their toes, because if we see a recession imminent, if things are really starting to turn, then a lot more of that can be absorbed and priced into the market. If we're in a muddle along scenario for a longer period of time, then people are a little bit confused about where does the market bottom and what is that catalyst for the market to bottom and then start to rebound. I think right now we still need to continue to pay attention to what the Fed is going to do and when they will pause and at what level they will pause. I think that will be a catalyst for the markets, at least in terms of reducing that form of uncertainty when we get to that point, whenever that may be. But I'd say in terms of the investing strategy here, we can't get caught up in the uncertainty and get this investing paralysis waiting for a catalyst. We need to be sensible in our portfolios in terms of moving higher in quality in both stocks and bonds, taking advantage of areas where valuations have reset, and really focusing on the fundamentals as we start to get earnings, sussing through which companies can be successful in some of these more uncertain environments in which rates are higher and the barriers to entry in terms of being successful are higher.
I just wanted to mention one thing that I'm just seeing on Twitter from Justin Wolfers, the University of Michigan economics professor. He said he's calculated the unemployment rate to the extra decimal places, which he said brings him to 3.468%, which he says is a new 50-year low, the lowest since 1969.
And that's a good jumping off point for this one, Julie. I mean, Beth Ann, last word to you. Do you think we need to just stop being on recession watch?
No, I don't think we actually have in our base case a very shallow recession. We do think that, and again, it's not necessarily going to be in the near term. It looks like it's being pushed out a little bit. But I do see that some of the pain that that households are feeling, the squeeze in terms of the inflation on their pocketbook, means that they are starting to pull back on spending. Businesses who basically switched from just in time to just in case are now sitting with inventory that they need to unload. That means if they unload it, they're going to unload it at a cost, and that also means that they're going to have to let go of workers. We do expect to see the unemployment rate to climb higher, and certainly nowhere near what we saw during the pandemic, but we're looking at it getting close to, I guess we have it at 5.6 by year end or early next year. So we do expect to see a little bit of a pickup there. But that unemployment rate, I would expect that's also one of the reason why that unemployment rate is indeed so low is because there's not that many workers out there even looking for work.
Tremendous insight. JP Morgan Asset Management Global Market Strategist Mira Pandit and S&P Global Ratings Chief U.S. Economist Beth Ann Bovino. Good to see you. Thanks so much. Appreciate it. All right, again, let's just recap those job numbers before we head to break. Non-farm payrolls increased by 223,000 in December, the unemployment rate at 3.5%. Markets reacting favorably to some downward revisions to jobs the prior 2 months. Also, sort of a downward revision to average hourly earnings as well. All right, we'll stay on all things jobs next with CEO Paychecks. We'll be right back. As investors digest the better than expected December jobs report, let's check in on how small businesses are faring with Paychex CEO John Gibson. John, welcome to the programming here. You're taking the jobs report this morning.
Brian, it's exactly what I expected. That's what we reported on Tuesday in our Paychex IHS job report. What we see is really job growth remains steady, but we certainly have seen for repetitive months now, wage growth continues to slow in small businesses.
And so for what we're expecting going forward from here, it's really just a matter of, for the companies that have already started to do some significant belt tightening, as we've talked about, or cuts, where those people start to find other jobs as well.
Yeah, I think, Brad, one of the things to keep in mind, but our report is focused on small businesses under 50. And so a lot of times, a lot of the headlines we're hearing are really about larger companies, some of which I actually think overhired for the situation, and we're kind of hoarding talent. In small businesses, we still have areas, leisure and hospitality is a good one, where they're still trying to catch up to the hiring where they were pre-pandemic. Now, what we're seeing in the other sectors is more full employment. They're getting back to where they are. Small businesses owners are being very cautious about adding employees, but they're still looking for employees and looking to even upgrade their employees, as you said, as people come into the job market.
And we also have been talking about the phenomenon of job hoarding, right? That many companies are reluctant to lay people off because they were so burned during the pandemic, not being able to find people, that when there's an upturn, they're worried about that again. Do you think that that is more acute among small firms than larger firms?
Well, I certainly think that for small firms, their impact and their ability to recover was much more difficult. So as you know, when the pandemic hit, everyone was kind of cutting staff. Then we started to ramp back up very quickly. Small businesses found it more difficult to compete against larger businesses. I think you saw larger businesses begin to take talent. And as small businesses recovered, they were really trying to hold on, retain. We saw them adding benefits, 401k, healthcare, trying to attract and retain their employees. I mean, keep in mind, remember the Great Resignation? That was just not too long ago. That was just early in 2022. And so everyone has been very cautious about holding on to the good talent they have and trying to get back to full staffing. And we got there probably about 5 months ago in small business in most of the sectors. And what we're seeing now is people are still trying to hold on to the talent they have. The labor market is tight, and they're looking for opportunities to upgrade talent if they can.
But John, what's their level of fear for the back half of this year? Because when I hear this week a Salesforce come out and cut 10% of its workforce and warn about a slowdown in orders, I have to imagine small businesses are feeling in many respects the same things.
Yeah, look, small businesses certainly are concerned about inflation. They don't have the pricing power of larger companies. They're also concerned about the tight labor market. So as we just talked about, the other thing that we're seeing coming up more frequently for small businesses now is access to funding. As you can imagine, as the Fed is raising rates, they're raising the cost of and the difficulty of getting access to capital for small business owners. So they certainly now are looking for ways that they can continue to fund their business, deal with any type of dips while continuing to deal with inflation. One of the things we're doing a lot of right now with our clients is helping them gain access to the employee retention tax credit. It's not a well understood opportunity. A recent survey said only 63% of small business owners didn't know it was available. And we've helped over 50,000 of our clients access billions of dollars. And the average refund that we're seeing for our clients is about $190,000. So I think that's something that policymakers and quite frankly, small business owners need to make available to them.
John, from what you're seeing, what are small businesses doing differently to court and ultimately keep talent in the workforce? People who have either left a job and are discouraged in looking for a new one, or have just left the labor force entirely?
Yeah, so one of the things that we've seen early on in the pandemic is more small businesses trying to enhance their benefit offerings. So one of our fastest growing businesses, we're the largest record keeper for 401k, focused on small businesses. We've seen a lot of growth in that. They're adding that. I think that's going to be further aided by the recent passage and signature by the president of the Secure Act 2, which is going to be able to really begin to level the benefits gap that exists between large businesses and small businesses. It's going to make it easier for employees of small and mid-sized businesses to save and access their funds in an emergency way. It also it provides a credit for adding a plan if you're a small business owner. It gives a credit for every dollar you match, up to $1,000 in some cases, and also helps small business owners help fund student loans through a 401k program as well. So those are the type of things they're trying to do to attract and retain their employees.
John, I want to ask you a wage question, because obviously we saw in the government report a slowdown in wage growth. You saw that in your report as well. And we were just talking with an economist from S&P Global who said some of it is reflective of that the wage or the job additions are on the lower end of the wage spectrum. Is that what you're seeing as well, or are there other sort of downward pressures?
I think that's certainly part of it, but I certainly think what we see is small business owners have been very resilient, and they've really drove a lot of productivity. The restaurants have reinvented their model of how they're running their restaurants, and so I think what they're doing is recognizing, they don't have the same pricing power of larger companies, so they've got to figure out how to get more out of less. So what we're seeing is they're working more hours. So in small businesses, the number of hours worked is up significantly, the highest we've seen in a while. We're seeing them really try to help their employees be more productive. So a lot of things that we're doing to drive productivity. So small businesses right now are trying to get the most out of the workers they can, and they're trying to keep wages low.
John Gibson, Paychex CEO, talking to us on this Jobs Day. Obviously, you have a very close association with this whole topic, and we appreciate your insight this morning.
Thank you for having us.
Thanks. Just to recap the numbers that we did get from the Bureau of Labor Statistics, 223,000 jobs added to the U.S. economy last month. That is more than estimated. The unemployment rate ticking down to 3.5%. And average hourly wages also decelerating to 4.6% year over year, a year over year gain. All of this being read as positive news for stocks. We are seeing them rise this morning. Coming up next, in addition to talk more about jobs, we've got information on Tesla cutting back on prices in China. We'll share the top 3 things you need to know this morning. Welcome back to Yahoo Finance Live. It is Jobs Day here in New York City, and I'm Julie Hyman alongside Brad Smith and Brian Sazi. We do have futures trading higher this morning. Right now, S&P looking at a gain of more than 1% at the open here this morning, and we also have been watching what's been going on in the Treasury market, where we have, as I scroll up real quick, we have yields going down, which is something else that has been fueling some of the gains. Investors, of course, digesting the jobs numbers, guys.
Indeed, they are, Julie. Non-farm payrolls up by 223,000 in December. The unemployment rate at 3.5%. And interestingly, the market so far, at least in the pre-market, taking these numbers in stride. But as we talked about in our pre-show with Beth Ann Bovino and Mira Panda from JP Morgan as well, that the market might be trading off here. And again, these pre-market gains have strengthened all morning long since that jobs report on downward revisions to jobs in the prior 2 months, as well as some I wouldn't say weakness in average hourly earnings, but perhaps growth a little bit less than people thought.
Yeah, and within the sectors that did see the most growth, we were highlighting this early: leisure, hospitality, healthcare. There was a question in healthcare of whether you would still see people enter into the sector given some of the honestly, some of the apprehensiveness after the pandemic. And I think what it's continued to show is that there are people who want to continue to work in healthcare, who want to continue to really be a part of making sure that with all the research and development, some of the new companies that have been spun off, these opportunities to work in that field, I think that this continues to show, and the broader trend line that we've seen getting back to some of the pre-pandemic levels, that there is so much excitement that still revolves around working in that industry, as well as some other. However, professional and business services, with some of the job declines that we've seen there, unfortunately, in this most recent report, down by about 6,000 jobs there. That really starts to get us into where, on the corporate basis, you're starting to see some of those layoffs start to add up as well here.
Yeah, they said information, that category, which would include things like programmers. I think professional business services can be people who work for tech companies in more corporate roles. Information maybe is the more pure IT services kinds of jobs. Those were a little changed during the month. And as you mentioned earlier, Saz, even when there are big layoffs at places like Amazon that we just announced, it's not necessarily effective in this jobs report. Even Amazon said it's not letting people know formally until January 18th that they're even not going to be working there. And it's when they come off the payrolls, right, that is when it's reflected in that payrolls number.
Right. I'm going to try not to jumble this, but 2 points from our prior guest, Beth Ann Bovino, and again, Mira Panda, I thought were very interesting. Beth Ann actually noting that we still need to be on recession watch. So we're seeing futures come out here, a lot of excitement build off of this report here. That, I think, is very telling. The Mira, and something you dug into, Brad, this notion of seeing a lot of dip buying on a sign or an economic report that maybe the Fed will pull forward when it pivots on interest rates. And Mira was hesitant to go all in on that notion that this report, you saw those downward revisions to jobs, maybe inflation is getting in control, go out there and buy stocks, go out and hit the buy button on those tech stocks. She wasn't buying that.
Yeah, wasn't buying that. And I think for a lot of people that are trying to kind of set their portfolio plays, it's really difficult to try and not just anticipate what the Fed may do, because there's going to be, of course, the algorithmic reaction as well as the trading desk reaction that takes place initially on much of these numbers. But it's really on once we get some of the minutes, as we had seen just last week as well, looking through some of the meeting minutes to really get the tone and tenor of how the Fed may act and look for a trend. And it's really just how many of these readings really make a trend for them that we're still waiting to see and get some more inclination around too.
And when it comes to recession watch, just 2 more things I want to mention. And this is an old saw, but the jobs market is a lagging indicator, not a leading indicator of the overall economy. So that's thing one. Thing two is the other thing Beth Ann said, and why she is still concerned that we could see a shallow recession, and that's because still inflation is, even if you're not seeing as much of gains year over year in inflation, people are still paying a higher price than they were a year ago, certainly than they were 2 years ago, and that is going to start to cut into consumer spending in a more dramatic fashion, and in business spending, which we're already seeing happen with a lot of companies not just cut jobs, but cut spending of all kinds, and so that is what then leads to that recession thesis.
We mentioned Cardi B yesterday in our stat of the day and feeling the grocery price. She followed it up with a very, I would say, explicit video yesterday afternoon explaining.
Cardi B, no.
Yes, very explicit, saying, yeah, of course she's paying attention to grocery price inflation, as she should be. Apparently she gets a weekly report of her bills, but at least from the prism of Cardi B, inflation is out there and it remains very omnipresent.
And the second major rapper to ensure that they are commenting and getting in on the inflation conversation, one Fat Joe.
Fat
also,
Joe, warning to Yahoo Finance.
Yes.
Warning to Yahoo Finance about
Your
inflation.
conversation.
Yes, absolutely.
Yeah. Well, there's another big conversation that we're going to have coming up with someone who's very close to the data. Be sure to tune in at 10 a.m. We're going to speak with the U.S. Labor Secretary, Marty Walsh, as well.
I thought we were teasing Cardi B there for a second. No?
I wish.
I love Marty. I'm
Marty's great too.
Absolutely.
Close second.
Yep.
Tesla cut the prices in different stories that we're tracking here. Tesla cut the prices of its Model 3 and Model Y cars in China by over 10% after deliveries of its China-made vehicles plunged in December. This is the EV maker's second time in less than 3 months that it's slashing prices. Now, a few things have taken place within that time frame. Number one is the production, and of course we got some of those production and delivery numbers. I think Tesla is really just looking for people to take delivery. That's one issue, but then additionally, it's a number of the credits that are going to continue to be rolled out too, and the extension of some of those credits, that makes financing even more possible for some people. So now that you've got another cut on top of the credits, on top of just trying to get people to take delivery, that's spelling out some serious issues that investors might be paying close attention to here on the day, which is why shares are moving lower.
Maybe Paul Meeks was onto something. Tesla hitting $29 a share. He came on, obviously we're not making a stock call here, but look, now the problem here with this is this reaction in the market to Tesla, pre-market, has nothing to do with what Elon Musk is doing on Twitter. This is purely fundamentals as it pertains to Tesla, them cutting prices, probably putting their margins at risk in a key market like in China. We're also seeing pressure on a NIO and an XPeng, those Tesla China rivals. And I would be more concerned about this market reaction than necessarily whatever is happening over there at Twitter, at least for right now, because that's what the stock's trading off of.
I mean, it might have nothing to do with Twitter. It might have to do with the short interest in the stock, which has been climbing, right? That is something that could potentially be exacerbating this, that there is definitely a financial interest on the part of some investors for the stock to continue to go down. That said, obviously, there's also the fundamental case of what's going on here for the company now cutting prices for the second time on these China vehicles in what is a really substantial market. By the way, they also cut prices in Japan by 10%, so that's something to consider too. It's not just in China. And one more point here that my pal Tom Hearden made over on Twitter is that the man who oversaw China and still oversees China, by the way, his purview was just extended. That's Tom Zhu, who just got a promotion, is now overseeing North America as well after what we're seeing in China. It's kind of an interesting choice here to expand that person's role.
Just lastly, and add on to this too, at some of the price ranges that we're talking about here, and it being down from the $38,000 figure that we had seen previously for the Model 3, $42,000 used to be that marker where if you saw the average selling prices dip below that, Tesla was actually taking a loss on every single vehicle. And so now this is a profit margin story as well. And any hit to the free cash flow for a company like Tesla too, going into a recession where there is fear around some of the car sales and moving through some of the produced vehicles, I think investors trying to get ahead of that.
And there's no stock buyback.
I mean,
there's no
I
stock
think
buyback
that is a
Tesla.
TBD because I think Musk has said that their operating efficiencies have improved on the vehicles, but I don't know to what extent. But so that to me is something we still need some more information on.
Sure.
All right, let's move on to another story that is an ongoing one that we've been watching, and that has to do with Southwest, which revised its fourth quarter forecast this morning after the airline had mass cancellations during the holidays that left thousands of passengers stranded. The airline adjusted its fourth quarter forecast, says now it's expecting a net loss. It had been a strong profit, and confirmed, get this, the total number of cancellations over the holidays, 16,700 flights canceled by Southwest, which is just, we knew it was a lot. But just to see that number, 16,700 from December 21st through December 31st is just quite something. And then there are some of the numbers here. Available seat miles, which is a measure of capacity, down 6% in the fourth quarter is what the company is saying. And it estimated loss of revenue of $400 million to $425 million. So this obviously, I mean, we knew this would have an effect. This just puts a little more detail around that.
I mean, for a company that's not expected to get back to full capacity until the end of this year, you got to imagine what a customer hit, this could really kind of kick off, or has already ensued as a result of some of the pain points and the struggles. But again, at the same time, there is a history of customers leaning into just price comparison despite one of the snafus like this. And so it is a question of if customers will still continue to say, you know what, they got the better price, we're still going to buy with them. We know what the risks are when we do fly anywhere. There could be cancellations, but you hope that as the capacity comes back up to pre-pandemic levels, that we do run into less of these issues. But this was more about some of the underlying software as well that you've pointed out.
Yeah, Raymond James estimating almost $600 million in lost revenue for Southwest because of this issue. And then I think the second thing you have to be on the watch for, who takes the fall for this? Is it CEO Bob Jordan? Is it his operations guy? No, the entire executive team at Southwest will not come through this, I would argue, unscathed. I think right now they would have to figure out how to get things resuming or back up to full snuff. And then, of course, everybody always likes a good fall guy, especially when you're losing hundreds of millions of dollars because of a process that you should have reinvested in 2-3 years ago.
Well, and I think you brought this point up when it happened. Gary Kelly, what kind of response? I mean, not that there's going to be a consequence. Maybe, I mean, I guess the consequence could be he would be removed from the board, but you know, the seeds of this problem were definitely sown under his purview because there were calls from the union and elsewhere prior to this for them to fix this system. I mean, it's interesting, you guys. I remember when Southwest has always been a discount airline, but it definitely had a great reputation, call it 10, 20 years ago, right? As being a friendly, kind of more fun airline to fly. And you have to think that that reputation is pretty severely, maybe permanently damaged.
Grounded. It's been grounded.
Oh dear. All right. And then one more story that we have to update you on here, and that is the battle for Speaker of the House. Still going on.
Still
it's going to resume again today for the fourth day after Republican leader Kevin McCarthy failed to secure the role in 11 rounds of votes. Republican hardliners stand firm on their opposition to McCarthy and their demands to reshape the House. We've now hit a 100-year record of the longest speaker election since 1859. The House can't conduct any other business in the meantime. Members can't be sworn in until a speaker is chosen. And we'll dive into this more later in the show with Evercore ISI policy strategist Tobin Marcus. Really fascinating story as it continues. Coming up, our next guest will break down her 3 key themes that will drive financial markets in 2023. That's next. Continuing on with our jobs day conversation, our next guest says soft landing expectations have been boosted with this morning's report, but the clock may be still ticking on a recession. For more, let's bring in Seema Shah, Principal Asset Management Chief Global Strategist. Seema, Happy New Year. It's great to see you.
Happy New Year.
What does this report tell us about whether indeed a soft landing is more possible?
Well, look, I mean, first of it's clearly a very positive report. You know, there were concerns that average earnings growth, average earnings would continue to stay pretty strong. So that is clearly a positive. But I think you have to look at actually probably the most important part of the report and say, look, the unemployment rate is your best picture of that demand and supply balance of the labor market. And the fact that it's come back down to 3.5% historic low tells you that the labor market is still extremely tight. So I have to be very skeptical that with that state of the labor market, you can continue to see wage pressures easing. So it's a positive, but I certainly don't think it changes the game, certainly for the Fed. And it doesn't really mean much with regards to changing the outlook for the economic hard landing that we're anticipating.
All right, so an economic hard landing, I mean, we heard shallow recession earlier. Economic hard landing, would that mean you see a mild recession or something that is more protracted than that?
Yeah, it's a really important question to ask, actually, because we get this a lot from our clients. So I think, at least from our perspective, when we talked about a soft landing, that to us is no recession. A hard landing is recession. Now, we are expecting the recession to be somewhat shallow, to last 3 quarters, which is the average length of a US recession historically. So this is something which is not anything close to the global financial crisis, but it is still a recession, absolutely.
Seema, should investors be buying dips on the markets going forward just based off of this jobs report?
No, I think that would be a foolhardy thing to do. You know, we have to look at beyond just the next month, the next couple of weeks, and just take a look back and say, look, the Fed has raised rates by 425 basis points in less than 12 months. They've already indicated very clearly that they're going to take rates even higher. And not only that, but they're going to keep rates high. And the economy hasn't yet really shown clear signs. So that pain for the economic perspective is still to come in 2023. So as you get that economic growth slowdown coming through, that will inevitably have an impact on earnings growth. So from an equity market perspective, there may well be days like this where the market does well. But taking a step back and looking at the big picture and saying, well, look at what the economy has been subjected to over the last year or so with rate hikes. And unfortunately, that does mean that there is a decline in earnings, which is on the way.
And Seema, looking at some of your outlook for 2023 overall, it seems like one of the big takeaways is that outside of the U.S., equities might be more attractive than inside of the U.S. Let's sort of take that point by point and talk about China first, because China is certainly part of that global outlook.
Yeah, you know, with the China reopening, what we should see now, look, at the moment it's pretty chaotic, and you could probably see that activity stays somewhat low in the near future. But inevitably, at the end of this, just like we saw for the US, for the UK, for Europe, that reopening should trigger a fairly meaningful bounce in activity. Now that's in the short term, but when you start to look out towards the end of the year, we are somewhat concerned that some of the previous concerns about China starts to return. So what are they going to do with their regulations? They're not really letting go of their common prosperity goals. So we are not entirely convinced that this is going to be a sustained rebound, but certainly in the short term, at least if you're looking at over the next 6 to 9 months, this could certainly be a good news story. And when you look at China's equity valuations, which are still flagging pretty cheap, that could be a good opportunity for short-term investors.
How would you evaluate companies, though, here in the U.S. that have the most exposure to China, either on revenue side or on the production side?
It's a great question. You know, one of the things that we've been worried about, is particularly when you think about large cap companies, is their exposure to external forces, to outside countries, Europe, Asia, which have struggled not only with supply chains, but just generally with their recovery. If China's growth outlook can really pick up to a point where it actually has a very positive impact on countries, on their main trading partners across Europe, across Asia and emerging markets, then certainly that would mean better news for large cap. But at this stage, I think the jury is still out, at least in the short term, for large cap companies. So we are not yet increasing our exposure to those. And instead, we still prefer the mid-cap companies within the US, which still have a slightly greater domestic exposure.
Seema Shah, Principal Asset Management Chief Global Strategist. Always good to see you. Have a great weekend.
Thank you.
Straight ahead, we'll look at a few hot tickers on the Yahoo Finance platform ahead of the opening bell. One of those names being Yahoo Finance Company of the Year, Costco. We'll be right back. Welcome back to Yahoo Finance on this Jobs Report Friday. Let's dive into a few hot tickers ahead of that opening bell on Wall Street, starting with our company of the year from last year. That'd be Costco. The retail giant reported total comparable sales for December that beat the average analyst estimate for the month here. Same-store sales, really good month for Costco. Core same-store sales up 7.3%, and more importantly were these two things. Year-over-year inflation moderated, that is good, maybe help improve the profit margins at Costco, and then also some renewed strength in non-foods categories. And we talked to Costco, the CEO, Craig Jelinek, a couple of weeks ago or about a month ago for our company of the year. He said he was seeing some weakness in discretionary purchases. So the fact they came back in that key month of December, right smack in the middle of the holiday season, is a positive sign, and that's why the market likes it.
Some weakness in e-commerce too. I wonder what it's going to take for e-commerce play to really kind of ensue or kick off at Costco in a wave that we've seen at the likes of a Walmart and subsidiary Sam's Club and some of the other big or buying in bulk retailers, but then just broadly across retail as a whole. And that's been such a boon to their ability to grow out their membership base, grow out this rewards base, and kind of that loyalty fan base that they have as well. And I wonder how that could really benefit Costco in the future if they were able to kind of lean into that even more so instead of just buy online, pick up in store. And so the e-commerce front, even though that was down by about 6% over the past 5 weeks and 18 weeks down by about 5%, wondering what type of investments they'll make in this near term.
I was just going to say, when you're talking about the big ticket items too that are maybe, or people maybe not buying as much, Oliver Chen over at Cowen, who said that this is his top pick for 2023, said increased trade down in food and sundries could potentially offset big ticket item softness, in other words, if more people are coming to Costco in the view that they're going to get a bargain, then that can help offset some of the discretionary spending that's going away.
It is interesting. So Costco, I think they will admit, and they have, that they were late to the online game. And why they may not be in that same sphere as a Amazon or a Walmart and Target, they just have a very limited things, just stuff they sell online. Yeah. That's just my take. And also, there is something to be said about going into that store and having some form of fun experience, whether you like shopping and spending 2 hours in Costco on a Saturday morning, whatever it is. It could be fun. It is fun for some people to walk around these stores and be surprised by what they see in there.
Yeah, that's right. You can't buy the hot dog online for $1.50.
I wish you could, though.
A lot of people. But I think for Costco, I mean, we were just talking about another kind of buy in bulk or retailer that has really done well in the online game, but that has also kind of seen its share price really suffer, and now looking to find a suitor for an acquisition, and that's Boxed. I wonder if there is some kind of kicking of the tires that a Costco looking at a Boxed, and even the membership base that they have and the recurring kind of business to business end buyers, but then also the B2C side too, where there could be perhaps some integration opportunities there. But again, I mean, that's just speculation and something that I hope that they're already talking about.
Box shares up 17%. I guess somebody's listening, perhaps.
Just because of that.
Just because of that. Yeah.
There you go. Let's also talk about WWE. Those shares are on the move as well this morning and higher by about 12%, following news that former CEO Vince McMahon is returning to the company. Now, McMahon expects to assume the role of executive chairman of the board, and with upcoming media rights negotiations, as well as the demand for live content across all platforms, McMahon said in a statement that the only way for WWE to fully capitalize on this opportunity is for me to return as the executive chairman. Those his words.
And maybe put the company up for sale. Yes. That's the other piece of this.
And Guggenheim is putting forth some numbers on how much WWE could fetch in any sale, whether it's an Amazon, my wild card is a Netflix, but whatever it is, if and when that should happen. Guggenheim sees the best possible scenario for WWE being worth about $133 a share, even on a lower case scenario, about $94 a share, just based on the intellectual property of a WWE, not only the content they're producing today, but the decades of content that they have produced that many people are still going online watching to this day.
Guys, there's a lot of complications here, right? I almost think of Microsoft with Activision Blizzard and Bobby Kotick and the situation there with all of the sort of alleged abuses that are going on. Because Vince McMahon isn't running the company because of payouts he was allegedly making to women, right? And so he had stepped down after that reporting by the Wall Street Journal. Now, supposedly, he's coming back in. So, yes, he built this thing, but I think any acquirer is going to have to contend with that legacy. And does he stay on and run it? His daughter's been running it, so what does this mean for her? So there's a lot of sort of drama here, and an acquirer is going to have an appetite perhaps for that drama. And it's difficult to see him giving up control in an acquisition situation without still running this property. And sort of remind me of that as well, Brandon Ross over at Lightshed Partners said Endeavor could be an acquirer of WWE. Endeavor, which also owns UFC, which has its own sort of founder drama that's happening right now in the form of Dana White. So I don't know. I don't know who. I think that really adds a complication here.
Well, due diligence will have to be deeply, deeply done to expose any, if they are there.
Due diligence, but then what do you do about it?
What do you do?
Right.
What do you do about it?
Yeah, and a penchant for PR nightmares. Yes. So it would have to absolutely do the due diligence, but then just be ready for everything that's about to get thrown its way on the PR front, too.
Yeah, I guess so. All right, there's the opening bell on this Jobs Friday, and
for Contour Brands, Wrangler, maker of Wrangler and Lee jeans. There we go.
We got some jeans ringing the opening bell this morning, and a lot of cowboy hats happening as well. PBR 30, I assume that's some sort of
professional bull riding.
Bull riding, that's right. We knew about this. I really wanted to see the mechanical bull on the floor.
I can't pull off
the
a
New York
cowboy hat.
Stock Exchange.
I think you and Brad can maybe pull off a cowboy hat.
I can pull off a cowboy hat.
Yeah, I know you guys could. I can't.
I call that my Old Town Road look. Yes.
So we've got stocks opening here this morning on this Jobs Friday, and we have had a lot of enthusiasm for the jobs numbers this morning. The better than expected growth in payrolls, the lower than expected unemployment rate, all of it, and of course, very importantly, also the lower than expected wage growth. All of that leading folks to extrapolate things for the Fed here this morning, Brad.
Yeah, we're officially off into the races here in today's trading activity. And in the session early moments, we're seeing the Dow open up higher by about 0.8%. Nasdaq Composite, you're seeing that up by about 0.4%. So fractional gains for both the Dow and the Nasdaq, and the trifecta coming in the form of the S&P 500. So you've got green across the board for the U.S. major averages here. We were taking a look at some of the yields earlier on that had started to move lower. We'll get back to those. But the Nasdaq Composite, taking a look at the tech-heavy average here for mega cap tech, you're seeing things a little mixed right now. Amazon, you're seeing that lower by a little more than 1%. Apple, higher by about 0.5% right now. But Microsoft and Google, both of those are lower. So stocks for both Microsoft and Google down fractionally. But in the chip landscape, and we're going to dive into this just a little bit later on, but just to touch on NVIDIA, since it's so close to the others, it's up by about 1%. Also want to take a brief look at some of the sector activity that we're seeing out of the gate this morning. You've got 10 out of 11 S&P 500 sectors in positive territory. Sorry, there's 11 green boxes, but ultimately it's 10 out of 11 sectors that are in positive territory. XLY, the lone laggard right now on the day. Consumer discretionary, you're seeing that down by about 0.3% right now.
Very interesting. Let's talk about consumer discretionary company right now, and that is VF Corp. That stock is actually trading higher, even after it was downgraded this morning to underweight from equal weight at Wells Fargo. The analysts also lowered the price target of the apparel company from 32 to 24, citing management turnover, balance sheet uncertainty, and the expectation of a difficult first quarter. The stock was actually trading lower in pre-market trading, but perhaps things turned around with the jobs report. Basically, a big reason behind this downgrade is Vans, the classic streetwear and sneaker brand. And the analysts, they're saying that the uncertainty is simply too much to stomach, that there's a lack of innovation and excitement in core classics over at Vans.
Yeah, interim CEO Benno Dorer, a friend of the show, former CEO of Clorox, he's in there running the company now, and I just don't know what the catalyst could be to get VF Corp working again. Is it a sale of a brand internally? Is it a major cost-cutting plan? I know Benno's actively looking into this business. I am sure he will figure it out, but outside of an economic re-acceleration to the spring, it's just unclear what is a positive catalyst to get VF working again.
Well, I mean, for Vans and what we've seen in terms of the rotation in the skateboarder category, you've seen more skateboarders lean into the either Nike Dunks, the New Balances that have been out there as well, and really kind of this overflow of fashion that's made it into that particular sport culture. I think that is something that Vans, for as minimalist and as easy to get into some of those products on a pricing perspective that they were years ago, now that you've seen that rotation from the skateboard culture, that perhaps has hit on Vans. You've also seen more of the overflow from some of the more casual lines of SKUs that they had into things like Crocs as well. And so just the dispersion that you've seen from the types of buyers that they typically would have had, whether that be on the sport performance front or whether that just be on the casual wear front, I think that's something that could be impacting and have longer term implications for Vans as a subsidiary of VF Corp, which also had given us an update, a business update at the end of last year, in the third quarter of last year, really pointing out that there were some grim times ahead.
Yeah. And just a quick mention, Benno Dorer is still the interim CEO,
yes.
right?
Yep.
So that's also something that the analyst talks about as not a great thing to be great time to be going through a transition and not have a permanent CEO. So we'll keep watching that. Coming up, Yahoo Finance's Pras Subramanian spoke to the CEO of Ram on its new electric pickup truck. They're joining the EV party. We'll have the details next. Power wheels. Pickup truck brand Ram Trucks is announcing a new concept EV that wants to combine range, power, and the ability to take anything you throw into the truck bed. The Stellantis brand says a model similar to the concept will hit the market by 2024. Yahoo Finance's Prosper Running caught up with Ram to talk to them about this. I mean, it's getting that market's getting kind of busy here, Pros.
Yeah, Julie, you can add another entrant into that high-stakes battlefield for EV pickup trucks. Like you said last night, Ram unveiled that Ram Revolution 1500 EV pickup there. Full-size pickup, likely mirroring a production version coming out, but we'll see later this year. It's got a number of cool features like third-row jump seats, a retractable midgate that allows you to sort of open up the truck completely to fit like 18-foot objects and things like that. It has a summon mode called Shadow. Things like that. But anyway, the biggest challenge that a lot of truck makers face right now with EVs is batteries and battery size. I spoke to Ram CEO Mike Koval on some of those challenges they faced creating this concept.
Well, I think a couple of things. First of all, battery packaging, because the batteries are very, very heavy. And one of the things that we have heard loud and clear from our customers, and I think research continues to suggest and support that truck intenders and even current buyers are more and more open-minded to the idea of electrification in their pickups. But they tell us time and time again, please do not compromise, do not sacrifice the core attributes that we care about the most, which historically have been payload and towing. And as we transition in the future, range and charge time. So the architecture had to provide for being able to support the battery weight while still being, holding true, I would say, to the attributes that our customers care about the most.
So, you know, one of those things that they do care about the most beyond those other issues is also interior size and interior quality. Ram Trucks known to have some of the best interiors in the business, very upmarket, very luxurious. But also with the fact that they use 2 electric motors, they're able to expand the cabin by 4 inches. Doesn't sound like much, but that's a lot of space, interior space, legroom, et cetera, for people in the cabin. And that also allowed them to have that third row jump seat where the midgate folds down and these jump seats pop out to the side. So very cool stuff there with that Ram Revolution pickup.
And Pras, I know we've talked a little bit about this before, but I think of the core truck buyer, and especially a Ram truck out of all pickup trucks, as not being like the core EV customer. But we have some sample of it now. In other words, we have other brands that are out there that are selling. So what does that tell us about what the demand for a product like this could be?
I think you're absolutely right. I think Ram recognizes their clients like stuff like towing and things like that. And battery trucks aren't the best for that. So they're going to actually do a thing called, well, the Revolution philosophy allows for a number of types of options beyond battery electrics. They're also going to have range extending hybrids. So imagine a truck that'll allow you to tow a lot of stuff, a lot of weight for an extended period of time, but then also go into electric mode for when you're, in the city and need to have low emissions. So they're allowing for those types of options for users because they recognize that you're absolutely right. Not everyone wants a battery electric truck, at least right now.
Like your house, Pros. Enjoy. Have a great rest of the weekend, buddy. All right, let's hit a stat of the day here. If a recession is on the horizon, history shows that fixed income is a pretty solid place to hide out. Bonds return more than 10% on average during recessions, according to data from our friend Liz Young over at SoFi. Coming up, Goodyear is tapping plants to make tires. We'll have my chat with Goodyear CEO Rich Kramer next. Goodyear unveiled a tire at CES this week made from 90% sustainable materials. I talked with Goodyear Chairman and CEO Rich Kramer about the new technology and whether inflation has peaked for the tire maker.
We have two announcements here, one being a tire made out of 90% sustainable materials. And this is something we're really proud of relative to our goal of getting to zero greenhouse gas emissions down the road and helping the industry. You know, Brian, what you know from the last time we talked, we had a tire at 70% sustainable materials. Now we're at 90%, and we're proud of this. What we continue to do is really focus on taking more petrochems out of the tire, replacing them with biomaterials and other materials that will allow us to recycle the tire more. And we're doing that not giving up any performance, and in particular around rolling resistance, which gives you better fuel mileage, whether you're in an ICE vehicle or you're getting range out of an EV vehicle. So more sustainable, no takeaway of performance, and we're the first company to get to that 90% level.
All right, so two ingredients. I'll call them ingredients. I don't know what else to call them, Rich. I'll call two ingredients that stood out to me on this tire. You're using soybean oil and rice husk waste. Why those two elements in the tire? And you mean to tell me that the tire will not wear out faster because you're using those products?
Well, you know, Brian, you're exactly correct. So those two materials really got to give credit to the team for coming up with this. One, both of those actually don't degrade performance at all. They actually increase it. In fact, as we look at soybean oil, it makes a tire more pliable in cold conditions. It gives it more grip. And on rice husk ash, we use it as a place of petro-based silica. And what that does for us is actually improves rolling resistance on the tread. So this is a way of actually moving to those bio-based materials that I said and not giving up any performance. And in fact, in many cases, enhancing performance.
Why is a product like this so important to a company like Goodyear and its future?
Well, for us, I think, number one, it's the right thing to do as we think about the sustainability goals that we and our customers have. Secondly, it's what our customers are asking for. As you well know, we have Scope 1, Scope 2, Scope 3 goals that we have to achieve, and bringing a sustainable tire to our customers helps them achieve those. That's really important to us. And then when we add features like intelligence to it and our service proposition, we can bring a whole different set of solutions to customers as we think about the mobility trends that we see going forward around fleets, autonomous, connected, and electric vehicles.
How difficult is it to scale a product like this up?
So, Brian, it's actually a great question, and it is harder to scale because we're talking about a whole new complement of materials coming in, which means having to build a supply chain to be able to do that, and it's why having the right partners to collaborate with to get us those materials is so important. We're on the front end of that, but this is something that's going to continue to evolve. But, Brian, I want to tell you, this is not something that's just an idea that we have. While the 90% material is a demonstration tire, which, by the way, passes all Department of Transportation requirements, the 70% tire, the tire made out of 70% sustainable materials, you can actually go on our website and buy right now. So we're trying to bring this to life, even as that supply chain matures, to make sure that we're not just putting prototypes out, but actually bringing this to market.
When will I be able to see 100% sustainable tire from a Goodyear, and what would be in that tire that's not in this one?
So our goal is by 2030 to have a tire made out of 100% sustainable materials. Again, I'm going to give hats off to my team for their ingenuity, for their tenacity to get us to 90% today, and I'll certainly thank the collaboration we've had with our suppliers. I would tell you that other 10% is going to come from, again, replacing certain of the materials that we have to make sure we can get the performance we want. And it's ultimately going to rely on the collaborations with some of our partners to come up with some of the inventions that we need to replace that last 10%. But I'm confident that we're going to get there. I'm 100% sure we're going to get there.
We focus a lot on jobs and reskilling the workforce at Yahoo Finance, Rich. This seems like a real opportunity to upskill a lot of your workers. Would you agree with that?
I would agree with that. And I would say not only upskill, but I would say what we've seen is real purpose to those working on projects like this. So instead of just, getting a tire, giving us a new size or maybe a different tire one of our customer might ask for. This is really working on a social problem, an environmental problem that we have. So not only upskilling, but giving our associates purpose to solve a bigger problem is something that we've seen. The excitement internally is palpable.
One big problem for manufacturers continues to be is inflation, Rich. Have you seen any peak in your business, any slowing growth rates in anything that goes into a tire at this point?
Well, I would tell you, as you well know, the markets, particularly in Europe, are still giving us a lot of headwinds. The markets have been down as we went into the last months of the year, and we've still seen those high costs around some transportation, around labor, and around energy, certainly in Europe. But I would also say we're starting to see some of those raw material costs roll over. So as we get into the first half of 2023, we'll still see some of those headwinds coming. But Brian, I would tell you, as we look to the second half and as we look to some of those costs rolling over and we look to the economy perhaps picking up some more steam back then, we're pretty confident about the second half of the year.
One of my friends, Rich, knew I was coming to talk to you, and they recently had a blowout in the tire. It wasn't a good year, so that's a good thing. But they spent $400 to get one tire. I mean, the pricing has gone up a lot, and the economy continues to slow. Do you see consumers balking a little bit, maybe pushing it to the limit on what tires, how far they should even have these tires left on the cars, given, their financial standings and the pricing of some of these products?
Well, Brian, I would tell you two things. One of the things is that given the retail outlets that we have and our partners out there, we look very closely at tread wear as we take tires off as they get replaced. And I would tell you, we're not seeing tread wear going down to levels beyond what is normal. And that tells me that consumers are still in the mode of changing tires at a normal cycle. That's a really good thing. And yes, tire pricing has gone up, but that's also because, as we said earlier, those input costs have gone up so dramatically. And a way that we deal with that, and I'll go back to one of the benefits that we got from doing the Cooper Tire acquisition, is we have a whole lineup of tires at different price points for different segments that allow the consumer to meet the needs that they have. And I think that's actually one of the benefits that we got from that deal as well.
Do you think you have the opportunity to push through some more price here?
I think as we look at what our input costs are, it's something that we have to do, and it's something that we'll continue to consider. So yes, I do think it's something that we're paying very close attention to.
That was Goodyear Chairman and CEO Rich Kramer talking about a new tire technology. All right, coming up, Bed Bath or Bust. We'll take a trip down memory lane for Bed Bath & Beyond with a true friend of the show. That's next. This week, Bed Bath & Beyond said it could go out of business and may file for bankruptcy. Arriving to this dreadful point didn't happen overnight for the home goods retailer. No, it reflects years of mismanagement that has led to shoppers going on Amazon and Target to buy their home goods. One of those shoppers is one of our fearless leaders here at Yahoo Finance, a true friend of the show, Didi Thomas, senior executive producer here. Didi, so good to see you. I actually sit next to you in the office. Welcome,
Yes.
welcome. And we were talking yesterday about the downfall of Bed Bath & Beyond, and I think your experience with this retailer through the years really says it all and explains why the stock is hovering around $1.
You know, I've been thinking about it. You and I have actually spoken about this company more than any company that we cover. And part of it is because I had a visceral connection to Bed Bath & Beyond. I can take you through my experience of walking into the store, going in there for 2 or 3 items, and then you walk in and there's a wall with, towels, bath towels and beach towels and then lanterns, and I'm thinking, oh my gosh, I'm gonna have an outdoor party this year.
It was magical.
And I don't have a balcony, I don't have a deck, but I was gonna have an outdoor party. And then I'm going to get my can opener, and then, oh wait, there's a Pyrex dishes, and there's aluminum foil, and then you go across the aisle and it's like, there's frames to the right, or there's food from every part of the country to the left. And it's just like, I would pick up this and pick up that, and it's like, wait a second, do I need $60 worth of frames? Yes, I do. And then it go through the store. Like I can tell you, I probably for 10 years only bought my shower curtains at Bed Bath & Beyond. And I wouldn't buy a couple. I'd buy the one that I loved, and I'd go back in a couple months and they wouldn't have it, but I'd find another one. And I can just remember that experience. And looking at all of the dishware, and I loved that store. And I also knew that I was reeled in, right? Like the way that the store was built, it was to get to the exit, you had to pretty much pass through every single aisle of that store. And it was okay.
What happened? Like, when did you notice that you were in the store and this experience that you thought was magical? When did it change?
It was February, March of 2020. And we were just starting.
Wow, that's very specific.
I know. But listen, well, look at the industry that we're in. But I also know because I needed stuff and they didn't have it. And the store that I shop at, 6th Avenue and 19th Street, is a massive store, was a massive store. And I walk in there and there wasn't anything there. I was like, oh, wow. And that was when I realized, I'm gonna have to go online. And I just never went back. And a couple of times I remember going to bedbathandbeyond.com, I needed a lamp, I needed something. And it was a completely different experience, because the thing about, like I mentioned visceral, it was you want a pillow, but you end up buying 3 pillows because you see them on the couch and you see the green one, but then you see the green patterned one and you see the texture, and it's all there for you. So you pick those things up. That doesn't happen online the same way.
Where they messed up were the coupons.
Oh my gosh.
Look, I mean, you have vintage coupons there. When they got rid of the coupons under prior management, they lost tons of shoppers.
Yeah.
Yes, and this coupon is from 2013. My mom used to send me coupons. 2013, because, and you keep them, right? You keep them in the thing. And there was a point where you would go in and you'd have the coupons, and depending on who the register was, some of them would let it slide, some of them weren't. And it's like, well, I'm not gonna buy this if I don't get 20% off. Like, whose loss was that? I got it somewhere else ultimately.
It's also a question of, did shoppers get overwhelmed with the beyond capacity of Bed Bath & Beyond and want a more refined experience like the one that you were talking about, and just being able to go to an experience, say, I just want this. I don't want to have to wade through the maze, this IKEA-like maze of other categories and other products.
See, I wonder, had I not had to choose, would I still be in that? Because I loved that experience. It was a Saturday. I would go at 9 in the morning, get home at 12:30.
It was part of the day.
That was part of the day.
Yeah.
And I didn't do it every week. But now we're all so used to click, 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 and then and that's only because of the pandemic and the experience that we're in.
Didi, before we let you get back upstairs, where do you shop now? Where's your store?
So I CVS and Walgreens for like the Sea Breeze and the lotions. There's a Target nearby. It's a mini Target, which we've talked about. I'm not that much of a fan of, but like it's here and there. I might go to West Elm for pillows and things. Yeah. I do go to Target for rugs and things like that. There's a small hardware store, like a small business that we do get some things from that's really easy for us. So it's spread out, but a lot of it is online still.
Didi, great perspective. Thank you for bringing it to life. I'll see you back up on the
see you upstairs. Thanks,
Didi
guys.
Thomas, thanks so much. Appreciate it. All right, coming up. I'll take a break. I got it. All good. I know. I'm just all over the place right now. Coming up, we'll speak with Labor Secretary Mario Walsh on those latest jobs force numbers. We'll be right back. Welcome back to Yahoo Finance on this jobs report Friday. I'm Brian Sazi here with Julie Hyman and Brad Smith. Non-farm payrolls rose by 223,000 in December, above estimates. We're seeing markets trade up on these numbers. Really, as we've been talking about all morning long, likely because of the downward revisions to prior months and what that may mean to future Fed rate hikes. But Julie, over to you, staying on all things economy. Breaking news on that front.
And it's not good breaking news. ISM Services Index contracting to 49.6% in December. That is below the 55 reading that was estimated by economists and is the first contraction in this reading in 30 months, according to the Institute for Supply Management. The services side of the economy, which we thought had been going like gangbusters, right? A lot of gains in leisure and hospitality, people eating out, etc. So this is a bit of a surprise here, again, to see this contract 49.6%, that reading. I'm looking into the components here. The prices index is part of this, down 2.4 percentage points in December to 67.6%. Inventories contracting for the 7th consecutive month as well. 11 industries here reporting growth. But obviously here, this is not a great number in terms of economic growth, and those who might have been reassured by the jobs report might find this a little bit more sobering, but we're not really seeing stocks take a hit on this. Factory orders, we also got those numbers in the past few minutes for November. Factory orders down 1.8%. That's a bigger drop than had been estimated. And the November final reading on durable goods orders down 2.9%, which is in line with the earlier reading.
Market seems to like bad news.
Well, it's sort of, are we looking for Goldilocks again? Should we bring up that word again that was such a common refrain, Brad, for so long? Not too hot, not too cold, jobs still growing, but wage growth moderating. Now you get this services report. So all of that maybe means the Fed doesn't have to be too hawkish. I don't know.
Yeah, it is a policy pathway that the market's keeping close eye on. And apparently here in the trading session earlier on in the day, yeah, this is correct. XLE, it's moving higher by more than 2% on the day. You've got some major gainers here in the form of XLE. You've also got consumer staples moving higher by about 2% on the day. And then additionally, you've got some solid movement in materials. That's up by about 2% early in today's trading activity. Overall, the S&P 500 up by about 0.7%. But the outperformers really coming in the form of utilities, industrials, real estate, as well as the aforementioned XLP and B. And then additionally, taking a look at the Nasdaq 100 here intraday, mega cap tech right now, kind of mixed. Apple is really the major gainer there. That's up by about 1%, but Microsoft, Google, Amazon, all in negative territory. And then additionally, when we get to some of the trending tickers that we're tracking here on the day, shares of WWE have been halted. Some news pending there. And
the news came out. Vince McMahon is indeed returning to the board. I'm just seeing the news, so I just want to bring it to you here. He's returning to the board, and it looks like the shares are trading. It might be open again. I'm not quite sure. Actually, no, it looks like they might still be halted. But in any case, it looks like that he is coming back to the board.
His daughter's still there. His daughter,
Stephanie McMahon, still there. So he's just coming back to the board. It doesn't look like he's coming back as CEO, but the company is going to undertake a review of options, which is, as we know, is euphemistic for maybe is going to put itself up for sale.
This is still a Vince McMahon board. You have his daughter there, Stephanie McMahon. You have Nick Khan, who he hired, who's been running point on a lot of operational things inside the company. And Triple H, who is Stephanie McMahon's husband, also staying on that board as well. Also bringing back two former executives that were fired a couple years ago, George Barrios and Michelle Wilson.
I pulled this up, 1 year chart here, 52 weeks, because as our viewers will remember as well, McMahon had actually stepped down from his position. There were allegations of sexual misconduct and then continued in some capacity still with the board. And then his daughter, as you were mentioning a moment ago, had really assumed those roles of co-CEO. And so now with this return, you're seeing WWE shares move higher, but it was really around this inclination, or at least the expectation of him coming back was around the inclination to capitalize on upcoming media rights. Now, what those media rights may look like, that still is yet to be seen and determined and communicated to the street. But at least as of right now, it does seem like shares continuing to hold on to some hope for those media rights that come through and get negotiated as well here. Also, switching gears, the U.S. economy saw employers add 223,000 jobs in December, coming in hotter than expected. However, a modest slowdown from last month's data, while unemployment slid to 3.5%. Here to discuss, U.S. Labor Secretary Marty Walsh. Labor Secretary, always a pleasure to have you here with us on Jobs Day every month. When you see a reading like this, what does that signal to you, and where do we need to continue to do even more work to get people back into the labor force participation?
Yeah, well, as you said, the report is a good report, a strong report. We're seeing areas like construction, leisure, hospitality, education, healthcare, areas that, quite honestly, I wanted to see a little more activity in happen this month, which we saw good gains in those areas. What we're doing now is laying out a plan for 2023 so that we can create better pathways into better paying jobs. The president worked with Congress on lots of legislation, whether it's the infrastructure bill, the Inflation Reduction Act, the CHIPS bill, where we're going to see a lot of manufacturing, a lot of construction, a lot of building, a lot of opportunity for growth. So we need to make sure these folks that are not participating in the workforce understand that there's a pathway into these jobs that get more people into the economy.
You know, I want to pick up on that last point a little bit, Mr. Secretary. It's great to see you, by the way. These measures that have been put in place that maybe will yield more jobs in the years to come, is that going, if there is a labor market slowdown, do you expect some of these measures that have been taken to sort of provide a cushion, provide a floor under the labor market in the next several years?
Well, I think, a lot of the buildings that are going to be built over next year, the next couple of years, these chip manufacturing, they're not going to stop producing microchips right away, but it's going to take a couple of years for the building to get up and running. So it gives us the opportunity to really work to get workforce development, job training, and apprenticeship programs, which we want to do more of, set them up so we can let people explore that there's opportunities in these different areas. I think that that's key. I think that, we looked at the labor participation rate. It ticked up a little bit this month. Certainly there's more room to grow. I was asking what the historic highs have been. I think it's about 67%. We're at about 62% now, 62 plus right now in the labor participation. So we want to get more people back into the economy. But also, one thing that is going to be really important for us is what Congress action, what will they take on immigration? When we talk about immigration, we think of immigration at the border, and immigration is, in my opinion, is one of the biggest threats to our economy. And historically, we've really depended on immigrants either through graduating college and staying here, graduate school staying here, or coming into our country working in these industries. So I think as we think about moving forward, we talk about what the economy is going to look like, we need to make sure that we're filling the jobs that are going to be created off of all the investments the president and Congress is making.
On the flip side, though, Mr. Secretary, is Congress and the administration going to have a tougher sell for immigration reform in a weakening job market? In other words, then does the argument come into play, well, we don't want immigrants coming into what is a tougher job market?
Yeah, I don't know if we're going to have, when you think about the tougher job market, I think that we're going to be creating more jobs in this country, and that's what the president wants to do, and create more good paying jobs. You think about just the manufacturing numbers since the President Biden's taken office, we have not only replaced all the folks that lost their job during the pandemic, but we're 100,000+ over new jobs created in the area of manufacturing. That number can go much higher in that area. You think about the ability for mechanical engineers, electrical engineers in this country, cybersecurity experts, jobs that don't exist today in our country, but we know the forecast down the future, we'll need these jobs. There's lots of opportunities for jobs that will be created over the course of the next 2 to 5 years.
Mr. Secretary, recently some gamers at Microsoft were allowed to form a union inside of that company, a win for the union movement, I suppose. Do you think that could be a model for other big tech companies?
No, I think it can be. Microsoft, I believe that they voluntarily acknowledged the workers and they worked the contract out, and I definitely think there can be. And I think there's an opportunity here I think when people think of organized labor, they often think of strike or job action. And on the other side of that, organized labor needs to make sure companies are successful in America as well, not just by respecting their workers, which is what they do predominantly, represent their workers, but also making sure companies continue to remain profitable. And it's a partnership. And I think the Microsoft can be a great example of a partnership between organized labor, workers, and the company.
With the amount of kind of pre-recessionary belt tightening and even cost restructuring that companies are doing right now on the headcount side, is the White House at all concerned about what you're seeing in terms of the number and the size of companies that are announcing layoffs? We just heard from this week, Amazon and Salesforce, most notably, two of the larger tech and cloud companies here in the U.S.
Yeah, I'm certainly watching that. We're watching that. I certainly watch that as well, making sure that when you think of an industry, I've said this many times, you want to make sure that we have a diversity of industries in the country, and we don't want these industries to have to lay off because of what's happening in the market or what's happening in the world. And I think that we're going to keep a close eye on that. I mean, there's been rumors for the last few months about layoffs at Amazon and some of these other companies in the tech sector. We've seen some of them now this particular month, and we got to keep monitor that, see if it's going to be short-term or long-term.
To bring it back around to this morning's jobs report, when you look at the report altogether, does it reassure you to any extent that we are indeed going to have a soft landing or even avoid a recession in the United States?
I mean, it's hard to say that, but I think that when you look at the last couple of years, the first 2 years of President Biden's administration, and bringing back the jobs that were lost, laying down good, strong economic policy, dealing with tackling rising gas prices, which we dealt with a few months ago, dealing with inflation. There's a lot of moving pieces here, but I think that when you look at this report, I feel confident that we're able to add a good, solid jobs number of people back to the economy. We'll be able to see good, strong growth when it comes to year-over-year wages. And then on the other side of the coin, we're starting to see some of the inflationary pressures go down. Certainly, we want to bring those pressures down even more because the people, American people, feel at the kitchen table every single day. So our work isn't done yet. We still have more work to do there to bring those wages down. I mean, not those wages, excuse me, those inflationary pressures down.
U.S. Labor Secretary Marty Walsh, always good to see you. We'll talk to you soon. Have a great weekend.
Thank you.
After a 15% slide in the past month, Morgan Stanley analyst Eric Woodring is out defending the tech giant stock. Woodring contends demand fears are overblown and that the stock is, quote, attractively valued for long-term investors. Woodring sees fair value for Apple stock at about $175 a share. He's seeing shares of Apple up almost 2% on the session. Coming up, the NFL has officially canceled the game between the Cincinnati Bengals and the Buffalo Bills. Julie's back with that and other top headlines next.
Let's get down to business now with some of the other headlines we are watching this morning. The NFL is canceling the Buffalo Bills and Cincinnati Bengals game following Buffalo safety Damar Hamlin's collapse. NFL Commissioner Roger Goodell calling the decision, quote, difficult but necessary under the extraordinary circumstances. Doctors treating Hamlin said yesterday that he was awake and breathing and was able to communicate by writing. On Wednesday, first thing he asked, who won the game? U.S. authorities are reportedly investigating FTX's former director of engineering, Nishad Singh, as they increase the scrutiny on Sam Bankman-Fried's inner circle. Singh could be charged in as soon as a month if prosecutors find he had a role in the group's alleged multi-layer scheme to defraud investors and clients. He was reportedly part of the wire fraud chat, along with Caroline Ellison, Gary Wang, and SBF. And the longtime partner of deceased Capitol Hill police officer Brian Sicknick has filed a wrongful death lawsuit alleging that former President Donald Trump and 2 other men are liable for his death. Sicknick died a day after the attack on the U.S. Capitol. Washington's chief medical examiner ruled that he died of natural causes after having suffered 2 strokes. The lawsuit alleges that all that transpired on January 6th played a role in his condition. It is seeking $30 million among the 3 named, and of course, it is January 6th once again, 2 years ago. So anniversary today as we talk about this lawsuit, Saz.
Inflation continues to come off its peak, although it remains a slow process. Yahoo Finance senior columnist Rick Newman is here with a look at a few things that may be poised to get cheaper in 2023. Rick, tell me it's eggs, right?
No, it's not eggs. I'm sorry about that. Food is actually one of the things that may not get cheaper over 2023. We've got just a couple of factors pushing food prices up. Fertilizer prices are stubbornly high. Diesel fuel prices are stubbornly high. Not sure we're going to get any relief on those 2 things. So food may not come down, but a bunch of other things may come down in price in 2023. You're seeing a list of them there on the screen. Home prices are already declining on a month-to-month basis. That will probably continue into 2023. Rent will probably follow. And then cars and appliances, other things that depend on semiconductors. The chip shortage has been easing. So inflation did pound consumers in 2022. They're going to get some relief in 2023.
Are they expected to buy the things as they get cheaper?
They've been buying them anyway. I mean, that's one of the reasons inflation has been going up in these categories. So it's been a combination in 2022. It's been a combo of people do have the money to spend. I mean, one astonishing fact is that the average price of a new car in the United States is now around $48,000. I mean, that has soared during the last 2 years. And that's because automakers have not been able to produce enough cars because of the chip shortage, but consumers are still buying. So that has just done what happens in a free market, which has pushed the prices way up. So we're going to get more inventory in 2023. I think the biggest change in the car market is not going to be new car prices, which might come down a little bit. It's going to be used cars, which are probably going to come down in price by a lot. We saw insane inflation in used cars. It hit around 41% year over year early in 2022. That was a year ago. And that is going to reverse. We could even end up with a big glut of used cars by the middle or end of 2023. So there will be some deals there.
And then there is the biggest ticket thing, right, for most people, if not everyone, and that has to do with where you live, right? And this is also something the Fed has been watching really, really closely, whether it's rents or housing that people are buying.
Right. So it is a catch-22 in the housing market right now. Prices have begun to decline. But of course, mortgage rates have gone up. So rising mortgage rates is one of the reasons that home purchases have cooled off and prices are coming back down, because affordability is actually terrible right now. But this is going to stabilize. It could take a while. I mean, we may not get to a fully stabilized housing market this year, but we're going to see the trend in that direction. And prices are going to come down. We're already seeing the trend. And then when they sort of hit a sort of stable level, by then there's a good chance the Fed will be done raising interest rates. So interest rates and mortgage rates will stabilize. And then who knows what will happen? I mean, if we get a recession, it's possible the Fed will cut rates and mortgage rates will come down. But we are definitely going to get back to a more normal housing market rather than this crazy run up in prices we've seen during the last 2 years.
All right. Rick Newman on all things price tags today. Rick, appreciate it.
Bye, guys.
Guys, coming up, Kevin McCarthy strikes out again after the 11th vote in his bid to become House Speaker. We're going to speak with a strategist from Evercore ISI next. Republicans now leading the House with a razor-thin majority and already finding it tough to complete tasks with Speaker-designate Representative Kevin McCarthy facing opposition after 11 votes over the past 3 days. Here to weigh in is Evercore ISI Senior Policy and Politics Strategist Tobin Marcus. Great to have you here. Help us break this down. What is the pathway forward? Do we just continue on with the votes until no end, until somebody is selected to lead now the Republican side that has the House majority?
Good to be here. Yeah, at this moment, I think we're basically in a staring match. Republicans have been furiously negotiating. I think the McCarthy camp feels that they have an agreement that's going to be able to peel off some of the conservative hardliners, but it doesn't look to me as if they're going to be able to get enough to get over the finish line, at least not right away. So I think they're hoping at this point to run a kind of a two-stage pincer strategy where first they get 10 or so of the more reasonable hardliners on board with a package of concessions, and then just continue to apply pressure to the remaining holdouts who are more sort of firmly entrenched against McCarthy. But this could drag out. It certainly does not look like it's going to be resolved today. So I think this stretches probably through the weekend and into next week.
Tobin, you recently put out a note highlighting several key dates in the months ahead. How does what's happening now in terms of this speaker debacle, how does it impact some of the outcomes around those events?
Yeah, absolutely. I think that in terms of the proactive agenda that Republicans have come in taking the House, that they're intending to pursue, this speaker battle is not going to make a big difference. I don't think that there's anything really that they would do under McCarthy and won't do under a plausible replacement like Steve Scalise, the number 2 in leadership, or vice versa. Where I think it has a bigger impact is when it comes to the debt ceiling showdown that I expect in the middle of the year. We're going to hit the debt ceiling again, probably sometime late in Q1. Treasury is going to run out of so-called extraordinary measures to keep from breaching the debt ceiling in the middle of the year in late Q2 or early Q3. And I think that we're going to have a big, protracted 2011 style showdown on the debt ceiling this year, because House Republicans are going to be really apprehensive about providing the votes to fix that. And so again, I think this looks much more like 2011 when the U.S. got its credit rating downgraded than it looks like some of the more performative fights of recent years. And I think that when you look at this speaker showdown, this is kind of a proof of concept for a small handful of conservatives to provoke a crisis that most House Republicans can see is counterproductive and self-destructive. And I think that we're going to see something similar in the middle of the year. So, I know a lot of investors might be inclined to look at this and say, there's not going to be a default. This doesn't ultimately matter to markets. I don't think there will be a default, but I do think that this is going to drag on sentiment and add uncertainty at a time that we may already be dealing with economic softening and markets may already be on edge.
That's a really interesting perspective. I well remember in 2011 when we had the downgrade of U.S. debt, and there was a lot of concern about the default. From a purely political perspective, there's been a lot made of how bad, allegedly, this makes the Republicans look to their constituents. I wonder how much they care, though. I mean, U.S. opinion is already pretty low when it comes to Congress. And so I wonder if this really does drive it that much lower, and what sort of real implications all of this has in that regard.
Yeah, I mean, it certainly doesn't help. Frankly, I think that opinion among Republicans is divided, among Republicans in Congress, because certainly, they're not monolithic as we're seeing this week. I think that the establishment Republicans do worry that this makes them look bad, both that it makes them look clownish and incapable of governing, which obviously is not the contrast that they want to draw, but also that it prevents them from doing the things that they want to do, many of which are ultimately intended for political purposes. They can't start their mini investigations of the Biden administration that they want to do until they get all this resolved. They can't, introduce all the message bills that they want to use to draw a contrast with Democrats. For the people who are staging this crisis, though, for the conservative holdouts, I think that they, for their political purposes, want to make a point of standing against the powers that be and drawing attention to this kind of clash between, conservative insurgents and, the swamp, the establishment, the powers that be. I think that serves their political purposes, which is part of why I think this is going to be so intractable. I don't know that they feel under a ton of pressure. I think this is, sort of largely working for them on their own terms.
If some other name emerges, does that mean that we would have a significant kind of positioning or stance change within the Republican Party as well, as especially as Kevin McCarthy and the state of California, their representation is starting to wither a little bit more at some of the top ranks within the House, given Nancy Pelosi no longer Speaker of the House, and Kevin McCarthy, at that point, if somebody else did emerge, then he would no longer have that kind of sway or say at the top there.
Right. I don't really think that it is going to change much of what they do, again, except for their ability to avoid these sort of unnecessary crises. Any speaker is going to have to govern from the center of this caucus. Their margins are so narrow in the House that there's just really not a lot of room for the speaker to kind of steer them in a more moderate or more conservative direction without losing enough votes at one fringe or the other that they can't assemble a majority to get things done. And so, again, we've seen McCarthy tack more conservative over the course of the past, frankly, decade, right? As he's been sort of pursuing power in the Republican Party, remains distrusted by conservatives, but I think he would be leading from a pretty conservative position. I think if you replace him with someone like, again, the most plausible alternative, Steve Scalise, that's someone who I think is more authentically conservative. If you gave him truth serum, I think he'd, be closer to where these conservative holdouts are. But I think they would pursue essentially the same agenda, just given how constrained they are by the overall makeup of the party.
All right, still a lot of suspense, Tobin. Thanks for helping us try to figure out what might happen. Tobin Marcus, Evercore ISI Senior U.S. Policy and Politics Strategist. Thank you.
Thanks for having me.
Coming up, we're going to do a deeper dive into those December jobs numbers and talk about what they mean for the markets with a strategist from eToro. That's next. December jobs numbers are, of course, in. 223,000 jobs were added. The unemployment rate ticked down to 3.5%. Our next guest says this continues to signal that recession fears are perhaps overdone. For more on this, eToro global market strategist Ben Laidler is joining us right now. Hi, Ben. It's good to see you. So does this mean the soft landing is indeed possible?
I think it does. This is really a sort of Goldilocks report. I mean, we've got enough of the sort of slowdown indicators to make us feel that, inflation is going to come down and the Fed can sort of back off. But, 220,000 jobs a month is completely inconsistent with a recession. And I guess we're seeing that in some other indicators as well. So, definitely, I think you're seeing some relief today. We've had some very strong other jobs numbers in the last few the ADP report and the JOLTS report, which I guess got people a little bit worried that maybe we were running a little bit too hot. And I think some of those concerns just got put to bed today.
If you're the Fed looking at this report, what do you think to yourself?
I don't think it really changes their trajectory too much. I think it's probably what they're looking for. Again, I think similar to the rest of us, there's probably a little bit of relief, right? We've had a lot of volatility in this report over time, but I think as you look through it, whether it's the revisions to the last number, which came down, whether it's this number, which is a pretty big, pretty chunky decline, whether it's the deceleration in the wage growth numbers. I mean, just take a step back. I mean, this is all about inflation. Almost all the other inflation indicators have decisively turned down. Whether it's goods numbers, whether it's commodities, whether it's supply chains, even the sort of housing, the forward-looking housing indicators. The one that's missing is the labor market. So I think, and the fact that it's lagging is not a surprise. But the fact that it's now moving, if but gradually, in the right direction, I think is a sigh of relief for the market, but also to your point, to the Fed.
Ben, we've seen markets really gain strength consistently today after this report. Do you fade this rally, though?
I think we're early in this sort of innings. I don't think the inflation story, I think that's got months to play out, but this is a good number. Again, it feeds into that broader inflation narrative, which I think is all moving in the direction. And we're pretty bullish on markets, right? I do think this sort of rates and inflation shock that you saw last year is absolutely going to fade. I think you're seeing a big recovery in China, which we don't talk about enough, but I think is a huge insurance policy against the global recession. And tech, which is by far the biggest sector in the market, I think is not going to lead up this year, but is going to have a less bad year this year than last year. And I think, given its size, is going to be very important of how this year plays out.
Yeah, we were actually discussing within tech some of the indicators to look for to really signal that the sector is ready for some type of bounce back. But one of the projections that we received yesterday was that we shouldn't look for that return in full force until the back half of 2024, which at that point would put us into an election year. And we know the tendency or the propensity for markets to kind of be sideways and just kind of flat, barely to the upside even in some of those general election years.
I think this is going to be a different year for tech. So last year was all about valuations being crushed and earnings being pretty resilient. I think this year is going to be about earnings, maybe not being crushed, but earnings certainly leading the market on the way down. And I think you're going to start seeing that in the fourth quarter numbers when we forget how cyclical some bits of tech are, and that, that $50,000 Tesla or that, $1,000 iPhone is ultimately a discretionary purchase, which many of us don't need to make. And I think that's going to continue to weigh. But I think the relief is going to come from valuations. You've had a complete turnaround in valuations in the last 12 months. And I think as we get to the top of this Fed cycle, as bond yields stay where they are or maybe come down a bit, I think that's where you're going to see the relief, which is the key ingredient, I think, to tech not having a repeat of its terrible 2022.
Terrible, but will it be down, Ben? Because if you indeed were recommending buying tech stocks right here, I won't say you're alone in the wilderness, but you don't have too many friends there with you.
Yeah, I mean, let's go now too ahead of our skis here, right? I do think the bottom for the market is in. I do think, call it the first quarter, where it's going to be choppy, right? This is this transition period as we get more visibility on inflation decisively coming down, especially those sticky bits of inflation and on top of the Fed cycle. So I think, that first quarter is going to have echoes of 2022, lots of volatility, 2 steps forward, 1 step back. So, keep it reasonably defensive. I think the things that worked in 2022 will continue to work in 2023. But the more we move further the more this market, I think, is going to de-risk, and you can take more risk. And that's tech, that's small cap, that's growth, essentially the things that just got absolutely crushed last year.
So does that mean energy still in 2023?
I think energy is going to be fine, but it's not going to lead, right? Commodities has been the big outperformer for the last 2 years. I don't think you're going to see that third year. I think this is a year when commodities takes a little bit more of a back seat. I think it's pretty well supported. I mean, the supply side is very, very tight. China's recovering, but I think, demand overall will be lower this year than it was, or demand growth will be lower this year than it was last year. So I think commodities will be fine, but I don't think we're going to see a third year of leadership.
Ben Layler, eToro Global Market Strategist. Good to see you. Have a good weekend.
Thank you.
Coming up, Yahoo Finance tech editor Dan Halley talks with CrowdStrike CEO George Kurtz from the Consumer Electronics Show. We'll be right back. It was a big week for tech, and Yahoo Finance tech editor Dan Halley had a front row seat to all the new announcements from CES. He had a chance to speak with CrowdStrike CEO George Kurtz and got his thoughts on the conference and key cybersecurity risks.
You've got to look at what the constant is, and for me, just walking around the show, there's really two constants. And that is everything has an IP address and everything has an app that goes with it. And then obviously what that means is there's always security risks that are associated with being connected like this. So I think just, everything from, crazy health gadgets to, car innovations, it's all here, and it all needs to be secured.
I guess, when you look at what companies need to be doing better as far as cybersecurity, right? We talked earlier with Jen Easterly, the director of CISA. She basically had discussed, how they need to make their software more secure from the jump. I guess, where do you see the need for improved cybersecurity? Where do you think we need to see bigger investments?
Well, it's a great question, and I just finished up a panel with Jen, and part of what we talked about is when we think about consumer electronics and the security problems, number one, it starts with we should put the burden back on the consumer. These devices should be secure out of the box, and they should be maintained secure for their lifetime. And part of the challenge that we've seen is that over the lifetime of a product, some of these products are around 10, 12 years. Take an IP camera, right? These are things that are not changed easily. And really, security becomes an economics problem, which means that the camera manufacturers are on to the 10th generation, but people are still using the old technology, and there isn't a financial incentive to keep things updated, right? There isn't, they just go out and decay, and they become orphaned. And this is really where you see risk. So I think part of what we're looking at here and what we do at CrowdStrike is how do we secure some of these devices? But I think in general, from an electronics, industry perspective, they got to think about how long they want to support these devices and building them secure out of the box.
I guess just, in light of the current economic climate, we're seeing some people pull back on spending. What do you kind of advise companies to do? Cybersecurity isn't something that stops just because, you don't want to make the investment, you can't make the investment. So what do you say to companies when they might want to pull back on spending on cybersecurity?
Well, I just have to look at my own experiences. I've been through several recessions. I've been at security for a long time, and I've been through many recessions, right? Not just this one, or, we'll call it a recession in probably 6 months. But what tends to happen is that the adversaries, and particularly the e-crime actors, become more active. Now, why is that? Well, there's less people, right? We saw the layoffs. There's layoffs, tech going all over the place, right? Less people to actually mine the store. Identity-based attacks, which are really, really important to guard against, are up, right? So you got people who are gone, access that's generally not terminated all of the time, and you don't have enough people mining the store. It really is the perfect storm for cybercrime actors, and that it doesn't mean your risk is going to go down, even though the stock market does.
Right. I guess when you talk about the current state of cybersecurity, is there anything in particular, 2023 going forward that you at CrowdStrike are keeping a focus on? I know we had hacks of municipalities in the U.S., hospitals. What going forward is kind of the big, I guess, canary in the coal mine for cybersecurity?
Well, when we think about where we are today in these electronics, a lot of this plays into critical infrastructure. It's not just about your iPhone, right? It's about many of these systems that are in critical infrastructure. A lot of these companies create technologies that are used there, right? So we've got to make sure that we safeguard our critical infrastructure. So we're always keeping tabs there. And then really the focus doesn't change from what it's been for many years. It's to stop breaches, right? And that could be in a consumer electronics device. It could be in a Windows operating system or anything in between. Even now, cars are all computer. I mean, there's computers, hundreds of computers, right? And we think about autonomous driving. So it's really about doing the basics, right? Making sure that the right hygiene is there, the software and systems are kept up to date, and that they've got technologies like CrowdStrike to protect those systems using advanced AI so that they can't be breached. And I started the company in 2011. It's our same focus, stopping breaches, whether it's today or tomorrow. That's really what we're going to be focused on for our customers.
And then just for our viewers and our readers, for the average person, how do you protect yourself, right? I mean, I just got yesterday an attempted phishing attack through text message.
Right.
My dad fell for a phishing attack. Sorry, Dad.
Yeah.
So I guess, what do you say to the average person to kind of make them feel safer?
Well, what can the average person do? I think in their daily lives, it's really a matter of safeguarding their credentials. That's probably the number one thing they can do. Keeping their systems up to date. Just turning on the switch, let Microsoft or Apple or whatever, or Android update when they have to, start there. And protecting those passwords. We see so many times that people just reuse passwords. And if one site is compromised by no fault of that user, it means that their credentials can be exposed across multiple sites, and that's typically where you see these data breaches. Use things like, these various password keepers that can create more secure passwords and make sure that you're not going to a text email that says, hey, you've been phished, or your Amazon package hasn't been delivered, log in here, or what have you. If you
That's
have
what
any,
almost got me the
right?
other day.
Okay,
Yep.
right.
Yep,
if you have any questions, and you want to be sure PayPal, don't click the link, just go to the PayPal website, log in, and see if it's for real.
That was CrowdStrike CEO George Kurtz with our own Dan Halley out there at CES in Las Vegas. Well, coming up, Peloton is facing a hefty fine over its recalled treadmill. We're going to share the details with you next. Welcome back, everyone. It's time for Cut for Time. 3 stories, 1 minute each. We start with this today. TikTok is the latest tech company to announce a hiring freeze. According to reports, the social media giant has stopped the process needed for consultants that would enable the company to work on an important security deal with the U.S. here as well. And so this is significant because it really does come down to the expansion pathway for TikTok. It's already come under scrutiny with regard to some of its data practices and alleged scrutiny that had started back in 2020 and has continued in terms of just some of the poking and trying to prod for additional information into how they manage the data that they're
Right, I hope this doesn't impact me. I don't know, just taping some TikTok dog videos. I mean, it's it's a very popular platform. I enjoy posting these videos and watching that of others. But look, so seriously, it's when you see a company like this in tech that has been doing so well, freezing hiring, not a good look.
Well, the South China Morning Post is saying it's actually laying people off, not just not hiring people, but that it's happening in China. So it wouldn't affect your.
I need to see the dogs. Cats. I don't need
It's
the
more
cats.
in China.
I don't need
You're
the
not
cats.
posting in China.
I want those.
Peloton is paying up. The company's agreed to a $19 million fine for failing to notify regulators of a defect in its Tread Plus exercise machines that could cause serious injury, according to the U.S. Consumer Product Safety Commission. This goes back a couple of years, as we know. The other thing is that the company was accused of reselling the recalled treadmills, which amazing. I mean, this is old news, right? We already knew that this has happened, so this is the resolution of this issue. But, just reminds us of some of the issues that the company's had.
In the spirit of the analysis that our friend of the show, Dee Dee Thomas, did on Bed Bath & Beyond, I went to a Peloton new shop-in-shop inside of Dick's Sporting Goods recently, and that deal was cheered as a potential big, huge win for Peloton. I went up there. It's buried on the second floor. They have a treadmill, a Peloton bike. Nobody helping you to buy one of these things. You can't buy a pair of shoes. It's a terrible presentation. Peloton needs to do a better job, and for that matter, so does Dick's Sporting Goods. Awful experience.
Yeah, I mean, and that was around the time where they were rolling out some of those big partnerships. You had Amazon, you had Dick's Sporting Goods, and you had Hilton partnerships. Some of those wholesale purchases, all of those in the course of, 2-3 weeks, and that one of those with Amazon prior to their earnings. But it's really a question of, for the consumer who has leaned into some of the in-home fitness solutions and connected devices, we've started to see the number of workouts wane, and the apprehension to purchase has really increased, unfortunately.
So true. All right, and trouble in paradise for the royal family as some claims and accusations from Prince Harry's autobiography, Spare, have been released. The Duke of Sussex is claiming he was physically attacked by his brother, Prince William, back in 2019. Wow, this saga just seems to have no end in sight, guys.
Well, you know what? It's good for book sales.
Yes, it is.
Good for viewership of their documentary series.
I liked it. I saw it.
On
I liked
Netflix.
it.
I am not a consumer of any of this stuff, but I imagine if you leak salacious details of your autobiography, then people will want to buy your autobiography.
You don't say.
Yeah, so, whether you care about the royals or not, I guess it's savvy marketing on the part of the prince.
Yes, from a marketing perspective, it is great. And as someone who does not track the royals to any extent outside of knowing their names, I think that for any of the endeavors that they look to really move forward with at this point, and it's really been around a lot of the content, but either on the entertainment side or the written side, sure, it's great for them. And
which one's Harry and which one's Meghan?
Can we put them on the screen?
No.
Wow, that's not very nice.
I'm kidding. I'm just saying we don't.
Well, last laugh I would say is on Harry. I mean, he still has his hair, so that's a good thing.
That's great, William.
That's a good point. All right, let's talk about what's going on in the markets right now on the basis of the jobs report, right? Because we did have largely a Goldilocks report. Ben Laidler brought up the word Goldilocks as well, and effectively that's what you got here, because you have a job market that's still growing, but wage gains are moderating. And all of that, so say the markets, means that the Fed is not going to have to get too crazy here.
Slowing job growth, and that ISM that you broke here, Julie, not so hot. Market is just eating it all up.
Yeah, and for where we're seeing some continued kind of nibbling, at least here on the day. I mean, the Dow is up 500 points right now, but take a look at the Nasdaq Composite as well. That's up by about 1.4%. It's going to be interesting to see when tech really makes kind of that full-throated rebound as well. And I think a lot of the analysts that we've discussed with are not holding their breath on that one in the immediate term right now.
Guess what's still in the red today, guys?
What's that?
Didn't recover. A company that we talked about way back at 9 a.m.
Google?
Take a look at the Wi-Fi Interactive.
Tesla. Oh, Tesla.
I got it for you. It is Tesla. The shares are still lower right now. They're down for about 4% over the past couple of days. And I know you love looking at this year-to-date chart.
Hey.
Weird as it looks.
Oh.
Down 12% thus far in 2023. First week of the year, not a good one for Tesla. So it is bucking the uptrend that we are seeing overall. A lot of green on the screen. Tesla's not among them.
Raise your hand if you are going to spend the weekend studying for bank earnings next Friday, people. Oh yeah, double hands up. We're going to do a little bank analysis. Going to spend the weekend reading some 10Ks. Very exciting.
Yeah, I was noticing that.
It's the saddest thing I've ever heard.
It's so very true. That's just me.
Well, also being dragged by Tesla is NIO this morning as well. NIO shares
What are you talking about? Enjoy your heritage flakes, Julie. Come on, what are you talking about?
Here, I have banks up here on the Wi-Fi Interactive. Why don't we take a look at those if you're getting ready? These guys are rising because, if you think the Fed is going to sort of thread the needle, if you will, it's good if the economy doesn't collapse for the banks, but rates still go higher. That's good for the banks as well. So, for what it's worth, here's the 1-year look at these guys. We have not seen a lot of increases, except in some of the European banks. Take a look at that, HSBC and UBS, but all the other big banks are down over the past 12 months.
Yeah, curious on what we hear from them on further job cuts.
Yes, that will be definitely something we can watch. All right, well, we'll be back next week with all the research that Saz is doing over the weekend on bank earnings. Brad and I will not be doing that. Akigo Fujita and Rochelle Akufo will take you through the next hour of trading on this Jobs Friday, including a conversation with an economist from Gusto. You don't want to miss that.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast and 8 a.m. on the West. I'm Rochelle Akufa with Akiko Fujita, and here's a look at what we're watching this hour. Some don't like it hot. A mixed December jobs report offers a hotter than expected headline number, but markets latch on to slowing wage growth. We'll ask our economist if it changes the trajectory for the Fed. And when the chips are down, Samsung posts its worst quarterly profit for 8 years. But the group's shares find something to shout about. We take a closer look at a downbeat report and what it means for a critical industry. And next generation tech, ChatGPT has stolen headlines and the attention of investors lately, but concerns abound that it could disrupt industries, corrupt students, and even take away jobs. We'll speak to an AI specialist on the future for generative media. But first, let's take a look at the major indices 90 minutes into the trading day. As we see there, the Dow, they're off to the races there, up more than 500 points, about 1.5%. The S&P up also 1.5%, 60 points there. And the tech-heavy Nasdaq there, up about the same amount, 1.5%. They're up 147 points. As we mentioned, they're latching on to some of the moderation that we saw in wage growth in Friday's jobs report for December. Let's also take a look at how that's been reflected in the Treasury market as well. As we can see, the closely aligned 10-year Fed yield there, about 3.59, the 30-year at 3.71, and the short-term 5-year there, down 4% on the day. All right, well, we're taking a deeper dive into the US labor market this morning following that latest jobs report. Now, the US economy saw employers add 223,000 jobs in December as unemployment ticked down to 3.5% and wage growth fell to 4.6%. We're here to break down some key takeaways on what this latest print means for the US economy and, of course, the labor market is Gusto economist Luke Pardue. Luke, thank you for joining us this morning. So, we've been throwing around this term. It's been this sort of Goldilocks effect when you look at the markets latching on to what we saw with moderating wage growth, but still keeping an eye on what we've seen with the headline number there, 3.5%, and a stronger than expected jobs number there.
Hi, thank you for having me. And I think that's exactly right. I would actually describe this jobs report as a Goldilocks report as well, where we've seen solid employment growth, just a bit higher than expectations, but we have been seeing that wage growth moderating. We saw 223,000 jobs added this month, a little bit down from November's number. And if you look at the long-term trend, we've been seeing this sort of slowdown in terms of jobs growth. The report actually estimated that last year in 2021, we saw about 562,000 jobs added on average per month. And that number came down to about 375,000 jobs added per month. So we're still seeing robust jobs growth. Federal Reserve Chair Jay Powell estimates we only need about 100,000 jobs added per month to tread water. But what's encouraging is to see that wage growth has been moderating just a little bit because those policymakers have been keeping an eye on that as they think about wage growth fueling inflation.
One other thing we also saw was the labor force participation rate tick higher. I mean, very slightly, but it was higher than what we got in the previous report. I mean, what does that tell you about the potential for a soft landing and sort of the best case scenario here, but being able to keep a strong jobs market while still slowing things down a little?
That is actually a number that I am very keenly keeping an eye on. I think you sort of have to squint to see that labor force participation rate rise this month, although it is encouraging that it did rise, but we're still about a percentage point below the level that we saw in February of 2020. So in order, as you say, to achieve that soft landing, to see robust jobs growth with a little bit of moderating wage gains, we do need a lot more workers to remain or to come back to the labor force, maybe thinking about older workers who retired or prime age workers who are having to deal with remaining childcare issues. And you know, in order to see a lot more employment growth while not necessarily needing to see wage growth, that labor force participation rate will have to at least return to where it was before the pandemic.
And Luke, what about the distinction you're seeing between what's happening with large companies and small to medium-sized companies? We know in that latest ADP report, they found that large employers cut about 151,000 jobs. But when you look at those with less than 500 employees, they actually added about 400,000 jobs in December. What does this mean for the overall labor picture?
Sure. Yeah. So at Gusto, we serve over 200,000 small and medium-sized businesses across industries and across all states. And so what we're seeing on our platform is a bit of a slowdown in hiring, that employers are starting to tap the brakes on hiring, although they still are adding employees. On our platform in December of 2022, the hiring rate was about 4.4%, and that's down from the 5.5% rate that we saw last month. And we've also been seeing employers moderate those wage gains, just like we saw in the overall jobs report. The annual wage growth among companies on Gusto Augusta was about 3.9%, and that's down from 4.7% last month. And that's actually the first month that wage growth was under 4% on our platform in 15 months, since October of 2021. And so what we're seeing is that a lot of small and medium-sized businesses are tapping the brakes on hiring amid economic uncertainty, but they're still adding employment. And what we're also seeing is that the employment growth is centered in leisure and hospitality, in healthcare and social assistance, just like this overall report. So a lot of what we're seeing among the overall numbers is actually reflected on Gusto's platform as well.
And what kind of indication do you have from those on your platform that this pace will continue? So you say tap the brakes on hiring, but still hiring. When you think about job cuts, it's still largely been focused in the tech sector. Any indication that that could really start to spill over in a big way into other sectors?
Yeah, I think that's the big question. That, as the Federal Reserve raises rates, we've seen the initial effects in interest rate sensitive industries like professional services. On our platform, the hiring rate in technology fell by just about half, from 5% December of last year to 2.6% in this past December. And the real question is whether or not those layoffs are starting to affect other industries, and particularly personal services. I just spoke to a bakery owner who said that they're based in San Francisco, and they're starting to see the initial effects of some of the slowdown in hiring among tech companies, because they need to get creative in how they're marketing some of their goods and pricing it. They actually just released they've been making cakes, and they released a less expensive taster pack in order to prop up demand, and they're having a lot of success with that. But that's kind of the initial way in which some of this softness and professional services that we've been seeing in the overall report could spill into personal services. Thankfully, we haven't seen that in a more widespread way. We're still seeing robust jobs growth in food and beverage and accommodations, but we're keenly keeping an eye on that in order to make sure that we don't see that sort of softness spill over into other industries.
Yeah, certainly hoping that that doesn't trickle down, as you say, into some of the other sectors. Luke, it's good to talk to you today. Luke Pardue, Gusto economist, joining us there. Well, from economic issues to political risk, the House entering its fourth day of electing a speaker. We have Yahoo Finance's Rick Newman to break down the chaos. Rick, you've got one eye on the economy, one eye on the House. Let's start with what we saw in terms of the jobs numbers, though, because President Biden says, look, this is a sign that my economic plan is working.
Yeah, and if you put the two together, Akiko, the economy is running smoothly on its own. There's been a lot of talk about, are we going to have a recession early in 2023, in the middle of 2023? We're not seeing it yet. And thank God, because if we needed any kind of fiscal intervention from Congress today, Congress would be unable to do it. Because of this circus with the Republicans trying to elect a speaker, the House is not functioning as a legislative body right now. It can't vote on legislation. It can't hold hearings. It can't do any normal legislating activity. I guess the assumption is that this is only going to last for a few more days, but it could go longer than that. The longest this has ever gone on in congressional history is something like 2 months. So at least for the moment, we can say the economy does not look like it needs any help from the government at this point, and that may be the case for the next several months and perhaps all of 23. So I think everybody looking at the dysfunction in the House would think that's definitely good news.
And so then when you look at perhaps some of the shifts in the front runners that are still up for Speaker of the House, how is this now looking now as we go into this fourth day?
I've given up on trying to predict who's going to win this, what the final outcome is going to be. But I think if you zoom out, and let's be honest, I think most Americans have either fallen asleep or changed the channel on this silly drama. But if you zoom out, I think one thing this whole specter is telling us is that these 20 far-right Republicans are going to have outsized control of the Republican agenda and outsized control of the House itself for the next 2 years. And if you look at these so-called negotiations that are going on between McCarthy and these 20 holdouts, basically what these amount to is McCarthy surrendering the power of the Speaker of the House through one measure and then another, so that a tiny minority of Republicans can sort of call the shots in the House. And I think this just tells us we're going to have possibly just chaos in the House for the next 2 years. This will matter when it gets around to extending the federal borrowing limit. The votes are there to do that because most Democrats, we forget about the Democrats, they still have 200, and I think it's 212 seats in the House, nearly a majority. But when it comes around to votes, most Democrats will vote for extending the borrowing limit, and so will many Republicans. But the question now is whether these 20 holdouts could change the rules or actually prevent a vote from happening. And this will also be an issue when it's time to fund the government for the next fiscal year, which begins in October. So this may not all matter that much for the next several months. The economy seems to be powering itself through pretty nicely, but this is going to matter later in 2023.
Rick, I want to get back to that point where you said, this points to the House's inability to legislate. I mean, we're talking about fiscal issues, one, but we've also heard of new lawmakers who, for example, can't get their briefings because they haven't necessarily been sworn in. I mean, can you talk about the implications the longer this drags on?
It just will reduce the relevance of the House on an ongoing basis. And I mean, let's also remember so the House is technically, I don't know how this breaks down. I mean, everybody is dusting off, the congressional rule books from 2 centuries ago to figure this out. But the House is not functioning as a legislative body right now. So literally every member of the House, since they get reelected, since they're up for reelection every 2 years, they are all new members of the House who need to be sworn in again. None of them have been sworn in. No House committees are doing normal House committee stuff. The committees aren't even formed yet. I mean, they haven't even appointed the members of the committees. So importantly, that means they're not holding hearings. And eventually they will begin to hold hearings. But again, to go back to what is the upshot of all this chaos that's happening, probably it means that these far-right Republicans, radicals, if you will, some call them the Taliban 20, they're so far-right, they will probably end up having more power over committees. They will have more power to direct the types of hearings committees hold, things that the committees might investigate. So, I mean, we are potentially looking at a real farce for the next 2 years, which is the amount of time these people will exert outsized control over what the House of Representatives does.
11 rounds of votes, and yet nothing.
Get ready for more.
Rick. We'll be ready for more. You're right about that. Rick Newman, as always, thanks so much for that.
Hi, guys.
Well, coming up, chip market mayhem. Samsung posts its worst quarterly profit in 8 years, but investors brush it off. We take a closer look at a downbeat report and what it means for a critical industry after this break.
Memory chip sector carnage hasn't spared Samsung, the tech giant seeing quarterly profits slumping to an 8-year low amid a choppy economic backdrop. Yahoo Finance's Ines Ferret has this story for us. Ines, an interesting one here for Samsung.
Yeah, Rochelle, and Samsung warning that its operating profit for the quarter likely dropped about 69%, revenue dropping 9%, warning about the prices for memory chips that have been falling and consumers and businesses really pulling back when it comes to spending. And why is this important? Because Samsung is seen as a bellwether for the global economy. It provides display and memory chips for Apple, and Apple has had some production delays in China, so that also has impacted Samsung. Now, the stock, which trades abroad, actually was higher today, and it closed higher. And why is this? Well, this is because analysts are expecting one of two things. One is for Samsung to cut its production or cut capital expenditures. And this is what Micron did after Micron had reported its quarterly results. Micron in December saying that it also had seen a slowdown in demand, prices for chips falling. And so the street is expecting a production cut, and that what that would do is it would restrict the supply of chips in the industry, and that would better meet demand. Now, Samsung will be reporting its full results on January 31st. Today, the semiconductors like Micron up 2%. But look, if you invested in this last year, I'm going to pull up a 1-year chart here so you can see over the last year how much chips have fallen. So certainly today seeing a little bit of a bump, in Samsung also a bump despite that profit warning.
And that's Ferret. Thanks so much for that. Well, our next guest says memory chips are poised to remain in a glut. Let's dive deep into that story with Ray Wang, principal analyst and founder at Constellation Research. Ray, as Ines pointed out, I mean, it sort of seems like investors are kind of taking this all in stride. You've said these boom-bust cycles are just part of the sector. How big of a concern are these numbers coming out of Samsung?
You know, Samsung is a bellwether. You saw the reports that came from Micron. Basically, we've gone from like a chip, scarcity in chips to glut, and I think this is one of the challenges that happens. And these are typical cycles. These are 2-year cycles that we see across in the market. And in this $500 billion market, we're expecting a 5 to 6% decrease in demand. Now, part of this is because we've gone from products to services. We came out of the pandemic. Everyone bought what they wanted. Then they wanted to get the experiences. China's got to go through that cycle as well. And that just means more access to being able to get the compute power is going to be much more important than getting chips into devices, and we're starting to see that happen in the marketplace.
So, Ray, how likely is it that Samsung will follow Micron's strategy of reducing production to really lift, especially the memory market?
Well, they definitely actually have to take that strategy because there is a glut. What actually happened in the pandemic is people basically overstocked because they couldn't get the chips that they needed, and there was a messed up model that was going on in terms of what supply was required. So the demand and the supply models were basically not in alignment, and we're starting to see that effect. And this is going to take about 6 to 8 quarters to recover.
So, Ray, that begs the question. I mean, we have seen so much investment, at least in the U.S., going into chip production. This is part of the Biden administration's push to try and build back at home. The concern all along has been this very issue you're pointing out, which is that there will be overproduction and a glut there as well. I realize right now we're talking about 6 to 8 months, but I wonder if you think there are knock-on effects beyond that we should be taking a look at, given where the investments have gone.
Well, the knock-on effects, you're right. One of them is really the chip restrictions to China. So we're going to overall have a lower demand, especially more specialty chips and more advanced chips. And the chip plants that you're talking about is the $39 billion investment that we see with TSMC. That's going to be in Phoenix and basically 2 brand new plants, right? And we're talking about new types of chips that are popping up, the 3-nanometer chips that are going to be produced. Those are going to be new chips. So they'll be a little bit different in terms of what's in the marketplace. But we are basically seeing a flattening of demand at the moment, but that will change in about 24 months. And it takes a while to put a chip plant up and running. And so this decoupling and deglobalization in terms of supply chains in China, that's going to take effect not just here in the US, it's going to take effect in Europe as well, as they're looking to be able to create chip production, and of course other parts of Asia that's trying to reduce their reliance on China.
And as you mentioned, that 3 nanometer chip, obviously the most cutting edge, and you're expecting Apple to lead the way in this. But Taiwan Semiconductor charges a pretty hefty price tag for these chips. What does that mean for what could potentially be for the cost of these phones when demand is already starting to weaken?
So the global demand on phones is slightly dropping at the moment. I think especially on the high-end phones, that's going to actually have some impact. But Apple's typically earlier than everyone else jumping into this market. You might see a delay in terms of how quickly those 3 nanometer chips are going to be consumed. But we also see a specialty chip market that's emerging. And I think the specialty chips, as we've heard in the auto business, you're going to see that as chips become more specialized in terms of their use. Those chips are actually going to play a role in terms of increasing demand for specialty areas as opposed to the general memory chips that we see today.
And Ray, while we're seeing some investors really kind of take the news today in stride, the semiconductor sector as a whole has been hit hard. Feels like a good time to buy. I mean, when you're looking at some of these names, who offers the most value, you think?
Well, right now, the most value are in a couple areas. AMD, given where they're poised. We see this here at CES this year. Some very interesting chips are being popped up. NVIDIA as well, in terms of their investment, in terms of what's required for AI and what's happening in large, high-scale compute. Broadcom's an interesting play because they have a much more diversified offering with the recent acquisition or to-be-completed acquisition of VMware. And, of course, Analog Devices is out there. And then, of course, for those who are actually playing in the market with TSMC looks like a potential winner in the long run.
Always great to get your insights. Ray Wang there, principal analyst and founder at Constellation Research. Have a great weekend. Meanwhile, shares of Tesla hitting a new 52-week low today on reports of additional price cuts in China. Now, the company announced it's slashing prices for its Model 3 and Model Y vehicles to shore up demand. Now, the Model 3 will now be priced at just over $33,000, while the Model Y will be slashed 24% from the price it sold for just 4 months ago. Now, this marks the second price cut in just 3 months, as the EV maker looks to compete with homegrown rivals like BYD. And this comes just one day after the latest data showed that Tesla's December sales fell to more than 55,000 cars in China. That's the lowest in 5 months. All right, stay with us. Coming up, shifting the balance of power. Are you one of 30 million American workers subject to a non-compete agreement? If so, you'll want to stay tuned for this next segment and some fresh FTC proposals. The FTC is suggesting opening up the playing field for workers, proposing a rule to prohibit companies from imposing non-compete clauses on employees. However, the proposal does not sit well for all in the business community. Yahoo Finance's Alexis Keenan has the details. Hey, Alexis.
Hi, Rochelle. Yeah, so this FTC proposed rule is, or would be, to stop employers from requiring non-compete agreements as a condition of employment. The rule now enters a 30-day public comment period, and if it is adopted, it would pose just a major shift for the rights of 30 million American workers, about 20% of the U.S. workforce, that are subject to these types of agreements, plus companies that have relied on the agreements not only to retain workers, but also to protect their intellectual property. Now, in a statement, the FTC chair, Lena Khan, she said non-competes block workers from freely switching jobs, depriving them of higher wages and better working conditions, and depriving businesses of talent pools that they need to build and expand. The proposal can be seen as really an extension here of Khan's already existing aggressive pursuit of antitrust action in the M&A space. But the idea behind this proposed change for workers and for businesses is based on this theory that non-competes really depress worker pay and the workers' employability, as well as decrease new companies from forming. So the U.S. Chamber of Commerce, though, has already come out and expectedly vocal about this proposed change. They're advocates for business, and they called the proposal, quote, blatantly unlawful. The organization said that Congress never intended to delegate this much authority to the FTC, and that it would also violate state laws. Though there are a few states that have already banned these types of agreements in California, Oklahoma, and North Dakota. So we can expect a lot of legal challenges, as you might expect, and especially to a feature of this proposed rule that would invalidate non-competes retroactively. So not just going forward, but agreements that are already in place for workers, those in theory would go away. Now, so far, there's no clear timeline as to when this rule would be rolling out if it is adopted. And there's also no real clear indication if the rule would extend all the way into non-disclosure agreements, which of course protect businesses from their trade secrets being shared with their competitors. Guys?
Alexis Keenan looking into that case for us. Thanks so much for that. Well, coming up next, generation tech. ChatGPT has stolen the headlines lately, but concerns abound that it could disrupt industries, corrupt students, and even take away jobs. We're going to speak to an AI specialist on the future of generative media. That's coming up. Well, here's a question for you. What measure is a machine? OpenAI, the research and development team behind viral bots like ChatGPT and DALL-E 2, could see a valuation of up to $29 billion. This at least according to multiple reports out from the FT and the Wall Street Journal. The developer OpenAI is in discussions with venture capital firms, including Peter Thiel's Founders Fund and Thrive Capital. The bots have recently gone viral for their ability to generate realistic-looking text and images. But while OpenAI says it can generate revenue by charging for usage of its products, that idea remains untested in markets. Rochelle, I feel like there's some context necessary here because $29 billion would make OpenAI one of the most valuable U.S. startups. And we're talking about a company, as we said, that has some skeptics who say, look, how do you actually generate revenue out of this? Now, last year, or we should say 2 years ago, 2021, this is a company that was valued at $14 billion. So we're talking $15 billion over where it is. And of course, this comes at a time when we have heard from so many VCs and startups who have had to slash their valuations because people are growing a little more skeptical about these companies' ability to grow. So in that context, a $29 billion valuation, especially largely based on ChatGPT, which was just launched in November, that's a significant upside.
I mean, you want to talk about just a turnaround story for more than doubling your valuation in 2 years. And as we mentioned, on something that's largely untested. And even OpenAI CEO Sam Altman saying, look, there are still some glitches in the technology. And as we're seeing a lot of VCs pulling back on investing on some of these sort of riskier businesses, we saw that just in the last quarter, we saw that some of these predictions, especially from PitchBook, saying that last quarter marked the first time in a decade that venture capital acquisition deals actually fell below $1 billion. And so we're not really seeing that momentum. So it's interesting to see so much interest now as people jump onto what we're seeing with ChatGPT. Now, obviously, this could pit Google against Microsoft with this. So it might be a case of sort of fear of missing out and wanting to sort of get in there early. But I mean, these valuations are really off to the races right now.
You mentioned PitchBook. They always have good data on where VCs are right now. The slowdown, yes, is happening in terms of valuations and the amount that's being invested. But they say that they have seen an increase of 425% between 2020 and 2022, at least in generative AI. So this has been kind of a hot space that VCs have been watching really closely. And, in many ways, some would argue that ChatGPT was just kind of the fire that was needed, but that potential has been there for a while. And want to see if we can continue the discussion here with a look at whether the market has a good gauge on where things are headed here. Joining us now is Nina Schick, a speaker, author, and advisor specializing in generative AI. Certainly a very timely conversation, Nina. And I saw you recently put out some predictions on where you think generative AI is going to go this year. You said this is the year where there's going to be exponential acceleration. To what extent has ChatGPT, the exposure that so many users have had to it, helped accelerate that?
Well, ChatGPT has really captured the public imagination in an extremely compelling way. But I think in a few months' time, ChatGPT is just going to be seen as another tool which is basically powered on this new form of AI known as generative AI, which has only been possible or in development for the last few years, with the applications only really coming to the fore in the last 24 to 6 months. ChatGPT is one of them. But what generative AI can do essentially is create new things that would have thus far been seen as unique to human intelligence or creativity. And generative AI can create across all medium. So text, video, audio, every digital medium can be powered by generative AI. So I think these valuations that you're seeing for OpenAI, I think are actually going to go up, and you're going to start to see even more generative AI companies, which have applications that are going to be universal across many industries in 2023.
I mean, and as we look at the future growth, I mean, in your book, Deepfakes, you predicted over 90% of online content will be generated by AI in 2030. That's not that far away. What does that path look like when you keep in mind that policymakers at some point are going to want to sort of step into what they call this sort of permissionless innovation?
So I actually think if I think about that stat, I might actually say I have a different view on that. I think we might reach 90% of online content generated by AI by 2025. So this technology is exponential. I believe that the majority of all digital content is going to start to be produced by AI. You see things like ChatGPT, which millions of people are already playing with to create text, but there are a whole plethora of other platforms and applications that are coming up. There are going to be more coming up in 2023 that generate images, that generate video, like I said, any kind of digital medium. Regulators and policymakers are going to be starting to look at earnest in this space in 2023. I think thus far, I mean, I have a policy background myself, the innovation has been so quick that policymakers haven't even figured out or realized what's coming. And basically, this is pulling into the station like a train. I mean, generative AI, that phrase was basically only even coined in the last 12 months. So policymakers, I think, are going to have a lot of work on their hands trying to figure out who should control this. I think the big debates are going to be around whether this should be open source or not. Who are the companies that own the kind of huge foundational models that are going to be used by numerous companies and numerous applications? And finally, I think there's going to be a huge public debate about, is this going to augment or automate humanity? I actually think it's going to augment, but I think there'll be a lot of people who differ with that opinion.
Let me press on the point about regulation, though, because to your point, these discussions often happen. To actually formulate the regulation takes a little longer. And you've pointed out in the meantime, innovation has raced out ahead of that. I mean, to what extent do you think lawmakers can keep up with regulation? How much of this needs to be a global conversation, given the implications?
It absolutely needs to be a global conversation because the implications, I think, are profound and universal. This can be conceived of as a new kind of communications infrastructure for humanity. And it's not only applicable in a narrow industry in one part of the world, this is applicable to billions of people around the world. I think where you're going to start seeing the conversation being had at a international level is probably first the EU, which is already looking at the AI Act. And I think a really important area for the future development of generative AI is going to be to see how these regulators look at the open source area, because a lot of the kind of innovation has been coming from the open source development community. So our regulator is going to kind of, are they going to basically try and shut that down so that these kind of capabilities are only then in the hands of big private tech companies?
Anina, I want to ask you something. Obviously, Elon Musk was one of the co-founders of OpenAI. And in response to an article talking about the New York City school district saying that they don't want schools and school devices to have ChatGPT on them, Elon Musk tweeted, you know, it's a new world, goodbye homework. What does this mean in terms of the potential for copyright infringement and protectors of some of these content creators as AI is sort of sourcing from all over the globe?
So you can conceive of generative AI as a new way or a new vehicle to produce all content. And of course, when it comes to copyright issues, there have already been contentious arguments about the fact that certain data sets have included data, including artist data, which was taken without their consent, so that when you look at some of the images, for instance, that are created on Midjourney or DALL-E or Stable Diffusion, you can do it in the style of certain artists. Now, that's been the whole debate around AI art. The debate around ChatGPT has more been about plagiarism, because I'm at CES and I was speaking to an influencer yesterday who basically said he submitted his final essays just using ChatGPT and he got 100%. So there's been a lot of anxiety around how ChatGPT can be used for plagiarism, but even more than that, again, how it can be used as a tool for anybody to just generate text. So you don't, if you are an author, a journalist, a copywriter, how this tool can basically automate what you do. Again, I just want to make the point that these tools, they are tools, generative AI kind of applications like ChatGPT, like DALL-E, like Midjourney or Stable Diffusion. They are only the very first applications. We have really hit the rate of exponential growth. The kind of scientific papers coming out, the innovation, the pace of acceleration is so incredible that these tools, which are shocking and awing us in 2023, at the beginning of 2023, are going to seem quite quaint by the end of the year because the capabilities are just going to increase so powerfully.
I mean, it's worth noting that, OpenAI was founded as a nonprofit initially, 2015. You had some big tech founders or big tech backers like an Elon Musk, like a Peter Thiel, but it still pales in comparison to big tech companies like an Alphabet, Google, right? I mean, to what extent do you think, their investments are likely to increase? I mean, how do they compete in this space? What do you see as sort of the makeup here as you see the space expand?
So the big tech companies, I think, in 2023 will continue to make their own generative AI plays, put a lot more focus in the space. I mean, there's been a lot of debate about whether OpenAI is an existential threat to Google, the fact that Microsoft is an investor in OpenAI, the fact that ChatGPT is going to be integrated into Bing. Is this going to challenge the dominance of Google? And although that's a fantastic story, there is no doubt that Google is developing its own generative AI tools. The amount of data they have, the amount of kind of talent, the amount of kind of AI expertise is so deep. And whilst they haven't released any tools publicly like ChatGPT, I think we're going to see a lot more from Apple, Google, Microsoft in this arena in this year. But of course, they've all got their eyes on these kind of new upstarts. I mean, we talk about OpenAI being a new player. It's been around for a few years, since 2015 when it's founded, but there are other players like Stability AI from the UK, which was immediately minted as a unicorn last year at its seed round. I think these companies that are coming up in the generative AI space, the kind of new disruptors, will continue to collaborate with the big tech companies, and the big tech companies will continue to invest in them. But also you're going to start to see the kind of tech titans unveiling their own tools and their own plays in the generative AI space.
I mean, this is a fascinating space to watch. So we hope to have you back. Nina Schick, advisor specializing in generative AI. Thank you so much for joining us this morning.
Thank you.
All right, coming up, intelligent tech. Will a sustainable future only be possible with smarter agricultural machinery? We hear from a John Deere subsidiary looking to change farming forever. Well, it was a big week for tech, and Yahoo Finance's Dan Howley got a front row seat at CES in Las Vegas. Now, he had a chance to speak with Willie Pell, Blue River Technology VP of Autonomy and New Ventures, hitting on the latest innovations, delivering products that enable farmers to work efficiently, sustainably, and profitably. Take a listen.
The big machine you see here is called See and Spray, right? So what this is an agricultural sprayer that is equipped with cameras and computers. And what you can do is you drive this machine over your crop, and it can detect the crop and detect the weeds with the cameras, and in real time compute what's what and spray only the weeds.
So it's only hitting what it needs to, and not what it shouldn't.
Correct.
Okay.
So the traditional way that you would control weeds in farming is you get a genetically modified seed, and then you spray the entire field, right? And so we're saving farmers lots and lots of money, like 70% in the herbicide bill, by only spraying the weeds. And it's just much better for the environment. So
I know that you have this. We can't obviously see it right now, but it's the exact shot. What does that do exactly?
Okay, so that's a planting technology, and so what that's doing is as the seed goes in the ground, it gives it this tiny little shot of espresso fertilizer, very small amount, but very powerful, right? So usually the way people apply fertilizer in planting is they'll just spray everything, right? You fertilize all the ground in between the seeds, which isn't actually valuable, right? All that nitrogen ends up running off into the rivers. And so we love these areas where we can save farmers money and make farming easier and more sustainable as a business, but also environmentally as well.
So yeah,
and so both of those things fit that really well.
I guess how much more efficient can a farmer be, right? I mean, you have these huge areas that you're covering.
So we think it's a big question, and I can have a pretty swaggy answer. What the place to start is called record-breaking corn growers, and so what they can do is, with non-economically scalable methods, grow 600 bushels in a single acre. Now, scalable methods will grow about 200 bushel an acre, okay. Right? So we think that there's a 2 to 3x, there's about at least 2x headroom on growing more food with the same amount of land.
Through this type of technology.
Exactly, this type of technology. Because basically the sensitivity, what that farmer does when he grows that big single acre is they walk the fields and they look at every single plant. And they treat every single plant as an individual, right? And they're looking at it and saying, this plant needs nitrogen, this plant doesn't, this plant needs, this, that, and the other, this plant has a bug infestation. So what we want to do is literally scale what that guy's doing, what that farmer's doing as he's walking the field, and just do that with equipment, right? Because you could never walk 1,000 acres like that, but this machine could, and these cameras could, and they can slowly start to pick apart all of these kind of inefficiencies and eventually treat every plant like an individual plant rather than a monolithic species.
I guess, as far as the way this can help new farmers, getting more women into farming, gender non-conforming individuals into farming, how does this help? And I guess, when can we expect to see, autonomy really take over the entire industry?
I think that maybe just as it's a good question. I haven't thought about it, but I think as a big picture, it just makes farming easier. So if you think about anybody who doesn't want to sit in a machine for 12 hours a day, right? You may love everything about farming, but when you're sitting in 12 hours a day in, day out, you might not like that. And whoever you are, they're probably going to appreciate that, right?
Yeah.
And so what autonomy does is it basically gives people their time back. The real intellectual work of farming is around understanding the weather, understanding what crop's going to work in what region, when should you plant. There are a lot of these sort of big, how do you market your crop? How do you sell it? When do you sell it? How much do you sell? These are the real business decisions. And then there's just vast amounts of fairly crank turning work that they have to do that involves dozens and dozens of hours in these machines. And so we think that by reducing the need for that someone who's intellectually very interested in farming, you might actually attract a new type of farmer, and whoever that may be, we don't know. But the goal is, let's make it as easy as possible, and let's have people do the things they're really uniquely that they're uniquely good at. Because we can't tell a farmer when to sell their crop. We can drive back and forth in the field and do a job for them.
Great stuff from Dan Howley there. All right, coming up, two-speed economy. Brutal tech layoffs are hurting thousands of workers in the sector. But all this is coming as some employees leave jobs of their own volition. Find out where and why next.
It is now time for our chart of the day. Small business owners seem to be finding some relief when it comes to hiring. According to a recent survey from Vistage Worldwide, in December, nearly 25% of the entrepreneurs surveyed said that it was easier to fill job openings now versus the beginning of the year. That's up from 18% in November. On the other hand, 20% said it was harder to fill open positions. Small business owners attribute the hiring relief to steps such as rising pay, adding apprenticeship programs, and rewriting job ads. Rochelle.
I mean, you figure some of these layoffs that we've seen from big companies, at least now perhaps some of the staffing trickling down to some of these small businesses, which have really been struggling to hire, as we were talking about with our jobs guest earlier today. So some relief there for some of these small businesses, and much needed, as they're all trying to sort of navigate what's happening with the labor market. And as we're seeing this, what we saw with that tipping point potentially with wage growth in this latest jobs report. Well, as hiring in some parts of the economy picks up, some workers are eyeing the opposite in 2023. They actually want to quit their unfulfilling jobs. Robert Half is out with a new report that shows that nearly half of US workers are planning to look for a new job in the next 6 months, with low pay being the top reason. Taking a look at the top jobs that people want to quit in 2023, number one is senior customer service representative, and second is software development manager. I did think it was interesting about the software development manager one, especially since that one comes with that six-figure salary, $153,000. So to see that more than half of them are looking for another job, perhaps it's a bit preemptive, maybe fearing some of these tech layoffs affecting them. But I thought it was interesting that for such a high-paying job, so many were still willing to shift.
Well, you have to wonder if they're going from one job to another similar job, but with a different company, right? Because if you think about where the tech demand is, despite the layoffs that we've seen from the major tech companies, what we're hearing is that these types of jobs are still very much in demand. So if you've got one company that's not giving you as much flexibility, let's say, why not go seek out another job with a different company that offers a little more than that? A few things that's kind of interesting to me in this. Number one, the likelihood of quitting was higher for those who held a job for less than 5 years at one company. And then, of course, you have to wonder how much remote work and this push to return back to the office is also going to affect those quit rates, too, because we've been hearing over and over for the last several months that companies want employees to return, and employees are saying, no, we don't need to be there. We've shown that we can be productive without it.
We're still going to keep seeing that push and pull as we try and find that sort of sense of normalcy with hybrid work. And when it came to the jobs that people were quitting the most, over 60%, senior customer service rep, human resource specialist, customer success manager, a lot of the people-facing jobs, as people I think are getting perhaps a bit fed up with some of the attitude that they're getting from people and from customers and looking elsewhere.
Yeah, certainly. Let's do a final check of the markets before we let you go. We have seen sort of an acceleration here. A lot of this coming through from that jobs report that we got today. The moderating wage growth, certainly a big accelerator catalyst, we should say. The Dow up now 628 points. That does it for Rochelle and I on this Friday. Thanks so much for watching.